investors are giving this bull market the benefit of the doubt.
This is starting to weigh on the market, but we have not quite seen that typical pullback.
Markets have essentially got an assumption that this could be a quick war.
We don't have a lens on when this is going to end. Nobody does.
The market right now is overly complacent in my mind.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, the war enters week 3.
We expect that the global economy is going to have a big positive shock as soon as this is over, and we're still being briefed that it would be 4 to 6 weeks from the beginning and that we're ahead of schedule.
One White House advisor indicating the war could take 4 to 6 weeks following another weekend of escalating strikes across the Middle East. The president is scrambling to put together a coalition to reopen the strait. That story is where we begin this hour. President Trump demanding other nations help to get energy moving once again.
We're talking to countries about policing the straits.
We are demanding that these countries come in and protect their own territory. It's the place from which they get their energy, and they should come and they should help us protect it.
Speaking to the Financial Times, the president saying if NATO allies don't help soon, the group will face what he calls a, quote, very bad future. The pressure keeps building.
Look, I can't get into President Trump's head and I can't get to the heads of the NATO leaders, but it does seem like there is a signal in all of this, which is there's not an easy off-ramp and it's not clear exactly how we're going to get an end game at this point. The fact that President Trump is reaching out to other people after, already saying some pretty mean things to them and saying, please get on board, gives you a signal that's potentially could go on for a while. Has the market truly priced this in?
The Journal over the weekend reporting the US could announce a coalition as soon as this week. No idea when that would actually become operational, and that piece of it is key.
Oh, it was interesting. It came Sunday night, of course, before the oil futures started trading and equity futures started trading. What was so interesting about the Journal report was this line. They are still discussing it, however, whether those operations would begin before or after hostilities end. Well, if they begin after hostilities end, when are we talking about potentially this coalition coming through and naval escort when it comes to the Strait of Hormuz? When they say potentially the end of the week, next week, 2 weeks' time, it really is unclear. There's a lot of lack of clarity in terms of what countries will be willing to sign up. Japan or Australia already said no. The European Union maybe are going to move their naval escorts they have in the Red Sea to Strait of Hormuz. But others, it's a big question mark.
This is going to take time, and that's the bottom line. That's why we're repricing crude further out along the curve. And strategists are starting to adjust as well. Morgan Stanley with this. Brent in the second quarter now seen at $110 a barrel. That's up from $80. For the third quarter, they now see it at $90 a barrel. That's up from $70. That story getting pushed out along the curve.
And I keep thinking about what Steve Auth over at Federated Hermes told us, which is that he is still constructive on risk assets up to $90 a barrel. But should there be an average price of crude at $90 a barrel for the average remainder of this year, that starts to curtail growth and materially changes his outlook to the U.S. equity market.
WTI this morning, 99. Brent crude just short of 105. Coming up this hour, Chris Verrone of Strategas with stocks looking to snap a 4-day slide. Norman Roule of CSIS as the U.S. ramps up the pressure on allies. And Kevin Book of Clearview Energy Partners as crude continues to climb. We begin this hour with our top story. Fresh attacks on a major oil port in the UAE, sending crude prices another leg higher. Our team coverage starts right now with Bloomberg's Jumana Basechi in Dubai. Jumana, welcome to the programme. Escalating strikes over the weekend, including that strike that we just outlined. What's the significance of what we've seen over the past few days?
Yeah, so there are two strands you need to think about. One is the U.S. administration's attempts to reopen the Strait of Hormuz, as you were just discussing, looking to build together a coalition of multiple countries to help provide some escorts or naval escorts for ships to traverse the strait in a safe manner. But already it seems as though there's skepticism around this plan. The Defense Ministry of Japan, for example, saying that the hurdle, the bar is very, very high for them to get involved. And of course, the main appeal would be to China, given the lion's share of the oil, the seaborne oil that passes through the strait does end up in China's hands. But still, they have not officially commented. So that is one strand of thinking coming through from the Trump administration. But then, of course, the other strand is the ongoing military operations. And what we saw on Saturday was a massive escalation with the U.S. striking Karg Island. Now, They did hit military infrastructure there. They were not targeting the oil infrastructure, but this is essentially the lifeline of the Iranian economy. About 90% of the Iranian oil that does get processed passes through the island. The fact that the U.S. are now signaling that they could go one step further on Karg Island marks a very deep escalation from their standpoint. And the Iranians have not taken it lightly. They have vowed to retaliate. They have re-emphasized that they are not open to a ceasefire, but also gone one step further this weekend, threatening to strike back at non-U.S. assets in the region and specifically in the UAE. They allege, this is what they're alleging, that the strikes on Karg Islands were launched from the United Arab Emirates. This is something that the UAE have rebuffed. They said it is based on senseless claims, and of course they continue to act in self-defense. But over the course of the last few days, we have seen a meaningful escalation. Earlier this morning, Iranian drones struck a fuel depot near Dubai International Airport. It caused operations to be suspended temporarily. And then in the last 24 hours, we have seen another strike, once again, on that Fujairah key port, very strategic port in the UAE for two reasons. Number one, it is outside the Strait of Hormuz, so it's not actually on the strait. It is one of the largest refueling ports in the world, but then also it's been playing a significant role for that oil land pipeline to get Abu Dhabi oil outside the Persian Gulf by not passing through the Strait of Hormuz. The fact that they have attempted to strike at it twice tells you that from Iran's perspective, they really are beginning to go after key energy infrastructure sites and not necessarily just U.S. assets in the region as well.
Jumana, stay close. Jumana Basechi out of Dubai this morning. The central bankers might have to edit some of those statements. The Federal Reserve meeting on Wednesday. On Thursday, the Bank of England, the ECB, the BOJ. This is a major week for central bank speak.
And I'm going to argue that the ECB is going to be a more interesting meeting than even the Federal Reserve, because what you're seeing is a bigger impact on assets in the region. And frankly, they're between a rock and a hard place, and an even harder place, given the fact that they're facing an inflation shock and a growth shock at the same time.
That meeting taking place this coming Thursday. The view on Wall Street this morning looks like this. Chris Verrone of Strategas, a Baird company, writing, "We think we still defer to the uptrend in equities. Keep an open mind and stay committed to price first, narrative second approach." Chris joins us now for more. Chris, good morning.
Thank you.
Price first, narrative second. What is price saying right now?
Yeah, well, listen, I think when you look at the broader picture here, most global equity markets are still in uptrends. At the same time, I'm not convinced we've really seen a deep flush here yet. And you kind of look to not necessarily levels, but what do the internal characteristics of this market look like? You know, we're sitting here with about 40% of the S&P above the 50-day. We really haven't seen the big surge in new lows yet. The put-call ratio remains pretty benign here. So things I would want to see to really mark some capitulative flush, I don't think have necessarily been checked yet. Now, that can change quickly. That can happen very quickly. I want to be open to that happening over the next week or two, but we haven't checked those boxes yet.
We've repriced energy. Yeah. We've repriced rates. Where have we started to reprice growth?
Well, I think that's the big question from here forward, and particularly when you put it in context of the Fed. You know, it's crazy to me that you see all these narratives being written that central banks are going to tighten into this. I think central banks have learned along the way you don't tighten into energy shocks. I think, if anything, you know, if this gets worse than people anticipate, we should be talking about more cuts, not less cuts down the line. And kind of our barometer to really economic growth, or how the market perceives growth, is what is consumer discretionary doing relative to consumer staples. Now, we've seen a modest correction in that pair over the last, 5-6 weeks, as you might expect. It's really essential to us. Things like that, or banks or industrials, can respond out of this. I think if there's a bigger problem developing, we probably still rally first. We learn about it in the summer as the real cyclical stuff starts to roll back over. That's the timeline for, I think, how this plays out.
Do you think that it's the same in all different regions? We were talking about all the central bank decisions and how it's crazy to think that anyone would be hiking into this, and yet people are expecting the ECB and the Bank of England to hike into this. Do you think that that's plausible, even as the United States maybe faces less of that kind of pressure? Yeah,
listen, I think one of the things that maybe was revealed again to us during the last couple weeks is markets are ruthlessly efficient at exposing what the weak links are. So you think about the last 2-3 weeks as this event has played out. U.S. 10-year yields, yeah, they're up, but they're kind of still in the same range they've been in all year. What's making new highs? German yields, French yields. What's making new lows? The euro. What's making new highs? Aussie, CAD. So the market is so ruthlessly efficient at really exposing where the vulnerabilities or the weak links lie. And I think the European bond markets are in a much more fragile spot here than the U.S. ones. I think the European currency is in a much more fragile spot. At the same time, look at how the commodity exporting FX pairs have all really asserted themselves here, whether it's CAD or Aussie or ZAR or Real. So this is a ruthlessly efficient market in exposing kind of where the fault lines are.
If that's the case, going back to what you guys are talking about, what's the signal in terms of what they're exposing in financials, given the fact that financials are down and down hard, regional banks down and down hard? Is that exposing some kind of weakness there?
You know, it's funny, of all the things you just mentioned, and we can talk about, you know, insurance and private credit and banks, the regionals are actually what I'm least worried about right now. The regional banks are still in uptrends. They're oversold here. I know they're down 10 to 15% across the board over the last couple of weeks, but they're not bad charts or broken charts. And even when you look at stuff like European banks or Japanese banks, they're correcting here, but really haven't corrected from big top formations. I think the bigger question is when you look at the traditional money center banks in the U.S., which entered the year kind of among the favorite of the consensus, right, because of deregulation and all the like. Can these respond here? You have oversold conditions in Goldman and Morgan Stanley and Bank of America and Citigroup. Can these actually respond here? That, to me, is probably the big question over the next 4, 5, 6 weeks. When you look at kind of the landscape of both geopolitical events and financial events, what you learn historically is underemphasize geopolitics, overemphasize financial events. I'd be much more worried if this is manifesting into the latter.
Chris, why is gold, though, under $5,000 an ounce?
Yeah, this has been something we wrote on the kind of the weekend that war broke out 2 weeks ago. We said, be very alert to what is behaving differently than your own intuition might suggest. And I think gold is, number one on that list. If you had just read me the headlines 2 or 3 weeks ago, you would have got, okay, gold's going to 6,000. The fact that it hasn't, I think, really reflects what was blow-off-like conditions from October through January. In gold, frankly, silver acts a lot worse here. Platinum acts bad. Palladium acts bad. I think these are all going lower. Come up with whatever narrative you want. I think the story will reveal itself in time. But I like precious metals lower here. And, in a lot of respects, I think this commodity bull market's diversifying, right? For much of the last 2 or 3 years, it was precious metals exclusively. I think that's less the story going forward. I mean, these grains have all broken out. I think the industrial metals are still in better condition than the precious. So something there is evolving. I like precious lower.
Chris, it's good to see you. It always is. Thanks for being here, sir. Equity futures right now in the S&P positive by 0.4%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump is demanding other countries join U.S. efforts to defend the Strait of Hormuz. The president says the United States is in talks with about 7 countries to help ships pass safely through the waterway. The European Union's foreign policy chief encouraging member states to redirect the bloc's Red Sea naval mission to kickstart that transit through Hormuz. Meanwhile, President Trump says he could delay his planned summit with Chinese President Xi Jinping later this month if Beijing does not help unblock the strait. The president stressing China's dependence on oil from the Middle East in an interview with the Financial Times. Trump also telling the FT that NATO faces a, quote, very bad future if U.S. allies fail to assist. And the key port of Fujairah in the UAE was hit by a drone this morning, halting oil exports. It's the latest in a series of strikes threatening the country's only export route. Fujairah is a major hub for both crude and fuels and has taken on increased importance for global markets because of its position outside the Strait of Hormuz, which, of course, has been all but closed since the start of the war 3 weeks ago. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate the update. Up next on the program, President Trump demanding a coalition.
We're talking to countries about policing the straits.
We are demanding that these countries come in and protect their own territory because it is their territory.
Up next, we'll catch up with Norman Roule of CSIS, live from New York City this morning. Good morning. The war in the Middle East stretching into a third consecutive week, and right now, crude up again for a fourth consecutive day. Brent crude 104 on Brent this morning, up by 0.9% on the month so far, up by more than 40%. In the equity market, 5% away from all-time highs. That's the correction so far, 5% on the S&P 500. Futures this morning positive by 0.5%. This from Mislav Matejka this morning over at JPMorgan. Have we seen capitulation? We've seen capitulation in sentiment, in our view. That suggests that if one is selling now, the risk of being whipsawed is increasing. The sense of things from JPMorgan this morning.
Yeah, and this is the reason why it hasn't been a deeper correction. The fact that everyone's waiting for some sort of statement saying, okay, we found an off-ramp, and then the rip-roaring rally that has come every single time we've ever gotten a downturn going back since the pandemic. Key question, if there is an off-ramp, will the rally be sustainable, or is there already a hit to growth, to your point earlier?
Nasdaq futures this morning up by 0.6. The Russell of small caps up by 0.5. Under surveillance this morning, President Trump demanding a coalition.
Talking to countries about policing the streets.
We are demanding that these countries come in and protect their own territory because it is their territory. It's the place from which they get their energy. And they should come and they should help us protect it.
So here's the latest this morning. The president ramping up pressure on other countries, demanding support for escorting vessels through the Strait of Hormuz. Trump threatening NATO with a, quote, very bad future and to delay his summit with China President Xi Jinping. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, the White House intensified calls this weekend to reopen the Strait of Hormuz as President Trump now calls on other countries to send naval escorts. Data analyzed by Bloomberg Economics finds that nearly 89% of total oil flows through the critical waterway do go to countries in Asia, and that includes 38% of total flows going to China. This, as President Trump, in a post on Truth Social, directly appealed to China as well as some other countries, including Japan, South Korea, France, and the UK, to all send ships. As the Wall Street Journal reported over the weekend that the Trump administration could announce as soon as this week a coalition has been formed to help secure strait passage, even as publicly many countries are non-committal about sending ships until the conflict resolves. New this morning, though, we did hear from the EU's foreign minister, who is urging member states to redirect a coalition of ships currently tasked with securing passage through the Red Sea to the Strait of Hormuz, though that plan at this point is far from certain. President Trump also ramped up threats in other ways, saying that the U.S. will strike energy infrastructure inside Iran if disruptions continue. This comes after the U.S. on Friday confirmed it had hit military targets on Karg Island, Iran's main export port for oil. Now, John, as these disruptions continue and we wait for the strait to reopen, the Trump administration has said that it is mulling multiple options to help with supply disruptions in terms of prices here for consumers in the U.S. I spoke with the Interior Secretary Doug Burgum on Friday, who told me there are a lot of tools in the toolkit, including potentially intervening in the oil futures market.
Tyler Kendall with the latest outside of the White House this morning. Tyler, thank you. To build on this conversation, Norman Roule, the former senior U.S. intelligence official and senior advisor at CSIS. Norm, welcome back to the program. We've seen reports over the past few days of moving additional assets into the region. In your mind, what does the next phase of this conflict look like?
Good morning. The United States is not preparing for a greater involvement that would lead to boots on the ground, but the commitment to the United States does remain focused on a coercive approach to this. There's no sign of a diplomatic engagement in the near term. So you basically have a situation where the United States approach is to beat down Iran's missile and drone capacity, to hit the regime on its police, its interior forces, in the hopes that this might provoke some sort of unrest, to open the Strait of Hormuz. And at the same time, the regime is trying to outlast this by striking economic targets that echo into the world economy to put pressure on the United States. Each side is trying to outlast the other.
Norm, when it comes to Karg Island, how significant was that hit over the weekend from the president?
Well, the United States certainly destroyed every military site on the island, and the island is indeed the primary artery for Iran's outlet of oil. It has no secondary outlet of any consequence. The port of Jask, which Iran has attempted to open in the Gulf of Oman, has a very modest output, but the Kharg Island appears to be operational for all of its oil output capacity. I think there are a couple of ships that burst very quickly after the U.S. military operation, and I think that's consistent with what the president was trying to do. He was trying to message the Iranians, look, we can touch you here if we wish. We're going to touch the military elements, but we could take this farther. Why don't you end the conflict? I don't think it changed the Iranian position, but it certainly sent a message.
In terms of the military strike on Kharg Island, what does this mean for the operational capacity of the IRGC?
Well, it doesn't really touch the IRGC's capacity per se. The IRGC's capacity is derived from its missiles, it's derived from its drones, and it's derived from its internal military placements that suppress the people. So it's got plenty of capacity that doesn't rely upon the economy, doesn't rely upon the banking capacity. It's accessible reserve. So it's not a money issue that keeps the IRGC going at present.
What role do you think that ground troops would play? You mentioned that it does seem like there could be a preparation to send a special unit of Marines over, potentially even to Kharg Island. Do you understand or have an understanding of what that would look like?
I think that's very unlikely at present. The U.S. commander's first option at this point would not be to create a force protection problem for himself. His goal is to create a force protection problem for the Iranians. This unit, although capable certainly of ground operations, probably would have its first goal to improve counter-drone operations and improve protection capacity for units, although some ground operations could conceivably be part of its mission. It's a relatively small force for such an activity.
Norm, are you seeing an off-ramp evolving here?
Not at present. The conflict will likely continue for some weeks on each side. But this said, the United States and Israel have absolutely eroded Iran's missile and drone capacity to a far, far greater degree than Iran ever anticipated. And the Gulf partners, particularly the United Arab Emirates and Saudi Arabia, have done an absolutely spectacular job of defense, as well as Bahrain, Kuwait, and the Qataris. And I think you're seeing that years of investment of training, equipment, and the leadership of these programs has done spectacular work. And indeed, Fujairah's ability to put itself back online demonstrates just the redundancy of the systems and the leadership of the Emirati oil program under individuals such as Dr. Sultana Jaber, where it's really coming to the forefront of keeping the world's economic programs going.
But Norm, at what point do the Gulf allies have to go to the White House and say enough is enough? There's a lot of reporting over the week about Mohammed bin Salman urging harsh action against Iran. But at one point do they say this is just too harsh right now on our economies?
I don't see that happening yet. Now, certainly there's going to be an economic blow. Remember, these countries derive their economic gains from tourism, from transit. Dubai Airport was hit today by a drone. That's a single drone attack. That's obviously a messaging attack by the Iranians. It's meant to disrupt. It's not meant to cause massive damage. So that economic blow is there. But these countries at the same time have shown tremendous resilience. So you're looking again at going to Abu Dhabi and Dubai and Saudi Arabia. They've shown tremendous capacity to keep their economies going during all of this. Expatriates are generally quite comfortable in these environments by many, many reports.
Hey, Norm, it's good to see you. Thanks for making time for us this morning. A busy morning. Norman Roule there of CSIS. As we're conducting their conversation, just getting some headlines from the Iranian foreign minister conducting a news conference, a press conference just moments ago. The war must end in a way that it doesn't repeat. That headline crossing just moments ago. The war must end in a way so that it doesn't repeat.
Right, which is deterrence, which is the reason why there is this escalating level of attacks, not just on U.S. bases, but also on infrastructure in the region.
We'll talk about crude and energy infrastructure in just a moment. We'll catch up with Kevin Book of Clearview Energy Partners with crude pushing higher. Plus, Yahira back with your morning movers. Meta. This is one to watch in the pre-market. The stock is higher by almost 3%. Reports over the weekend of widespread layoffs. More still to come on that story in just a moment. From New York City, you're watching Bloomberg TV. Stocks down for 4 consecutive days coming into Monday this morning, bouncing back by just 0.6% on the S&P 500. On the Nasdaq, up by 0.75%. A 4-day losing streak on the equity market, a 4-day winning streak on Brent crude. Brent looks like this so far this morning. Trimming gains. Brent at the moment up 0.33%, 103.43. What a move so far this month. And we're only halfway through this month. A 40% move on crude. Brent crude just about holding on to triple digits. In the bond market, 2s, 10s, 30s. Last month, the 10-year bond yield was down 30 basis points. This month, it's up about 30 basis points. We've been for quite a ride over the past 2 months. 4.25 on 10s this morning, going into the Fed this coming Wednesday.
Yeah, and it's as clear as mud in terms of how they're exactly going to signal this. Clearly, in the short term, it's going to be an inflationary pressure. But as you mentioned before, at what point does it become a drag on growth, given the fact that it's going to eat into consumer discretionary accounts? I do think this is interesting from Deutsche Bank economists saying that only a sustained $150 per barrel would eliminate the benefit that a lot of consumers are getting from the one big beautiful bill. So there is a threshold that people are watching for that pain.
2-year bond yields around 370, 369 this morning, declining by 2 basis points. Going into the Fed meeting on Wednesday, 2-year bond yields near the highest since last summer. 3 hours away from the opening bell, let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. Meta is outperforming the Mag 7, up 2.8% on a report by Reuters that it could cut 20% of its workforce, which could be 16,000 of its 79,000 employees. The move, of course, comes as it tries to offset that massive AI spending it's been making and could be a sign that AI is delivering meaningful productivity gains, as we heard from Block last month. Moving on to Sable Offshore, those shares rallying nearly 7% in the pre-market as the company gets the green light by the Trump administration to restart oil production off the California coast, despite opposition from regulators. We know that this is a fight between the White House and California that has been brewing for months, but with oil prices surging due to the Iran conflict, you can see how the administration is moving more aggressively to bring more U.S. oil supply to the market. And we end on private credit with Blue Owl shares rising nearly 1%, up for a second straight day, but it is a meager rise compared to the sell-off we've seen in this name, down more than 40% year to date as investors continue to worry about rising defaults, their software holdings, and redemption requests all over the private credit sector. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. On our radar this morning, President Donald Trump seeking support from several countries to secure energy flows through the Strait of Hormuz. Trump also telling the Financial Times that NATO faces a, quote, very bad future if the alliance doesn't join the war effort against Iran. Elsewhere, the UAE's Fujairah port hit by another drone attack. Oil loading operations at the trading hub have been suspended while the damage is being assessed. The port is the UAE's only export route outside the Strait of Hormuz. And finally, President Donald Trump threatening to delay his summit with the Chinese leader Xi Jinping. The Financial Times reporting the president may postpone his planned trip to Beijing if China does not help secure the Strait of Hormuz.
A lot of people are wondering how long this would take given the rising pressures on all sides. How much is this President Trump trying to get leverage for one of the key importers of Iranian crude, and what kind of incentive does China have to get on board and pressure Iran, given the fact that they're still getting shipments of that Iranian oil? There is a feeling, though, that maybe, at least according to some reports, China's getting a little bit annoyed with some of the practices of Iran, so maybe there can be some leverage, but this does seem to be an outgoing question.
Some vessels are getting through. You need a magnifying glass, but some vessels are getting through, and it depends on what flag is on top of that vessel. This hasn't been talked about much this morning, but it was talked about a lot going into the weekend. This from the Financial Times. The European countries, including France, had opened talks with Tehran seeking to negotiate a deal to guarantee safe passage. Now, ultimately, that story has gone nowhere over the past few days. But some comments from India just moments ago kind of speaking to the same thing at the moment.
Right, what India is saying is that they are in talks with Iran. We have seen some Indian vessels get through, especially when it comes to liquefied petroleum gas. 90% of India's imports of that for cooking oil relies on going through the Middle East and the Strait of Hormuz. What India is saying right now is that Iran didn't ask anything to give ships safe passage, but this is what the United States doesn't want. They don't want individual countries going to Iran one-on-one. They want this to be a coalition. And what this proves right now is that the strait is actually not closed. The strait is controlled, and it's controlled by the regime.
We've got a logistics problem, which is causing a production problem, and the president is aggressively trying to solve a logistic problem of his own making right now.
And that's the reason why it's kind of difficult to get coalition on board quickly after the fact without having communicated earlier. And the reason why Iran is really taking this step to negotiate individually with the companies.
But whether or not, 'cause there was a lot of talk about the fact that Trump named China in a Truth Social post as one of these countries that should come to help, whether or not China likes it or not, they're involved. 90% of Iranian exports go to China. The rest go to Syria and some other countries. But this is important for China, and higher prices are also important for China. So at some point, China's going to have to get involved.
And we're certainly getting high prices. Crude holding on to triple digits this morning. The average price for a gallon of regular gasoline topping $3.70 following fresh attacks in the Gulf. The U.S. Energy Secretary Chris Wright saying the White House's strategy remains on track.
We knew there'd be a temporary interruption of flows out of the Straits of Hormuz. This is short-term pain to get through to a much better place where the Middle East can no longer be held hostage by the one rogue nation in Iran. The conflict will come to the end in the next few weeks, and we'll see a rebound in supplies and a pushing down of prices.
The U.S. demanding allied support and projecting vessels through the Strait of Hormuz after striking Iran's main export hub. Kevin Burke of Clearview Energy Partners writing, if nothing changes, prices look poised to continue rising until they balance supply by destroying demand. Kevin joins us now for more. Kevin, welcome to the programme. I want to pick up on that line that came from the Energy Secretary just moments ago, that ultimately we'll see a rebound in supplies and will push down prices once again. If the war ended right now, this second, the headline crossed, how much damage has already been done and how long would it take to recover?
There's two ways to look at that, Jonathan. Good morning, and thanks for having me. The first is that there are forward-positioned inventories that are being drawn but not exhausted, and strategic barrels yet to follow. So if we stopped today and traders optimistically look forward, they might say, well, look, it's not so bad, it's a blip. The other side of that, though, is that we don't know how much damage has been done to all the facilities that have been hit directly or incidentally, and even the ones that shut down gracefully need weeks to restart properly. So there's still latency yet to come. And then on that second leg, that less optimistic leg, Jonathan, there's the question of whether or not the war takes a leg up on an escalatory pathway, expanding into other countries, directly engaging Iran, for example.
Kevin, when it comes to timelines, Total Energy also this morning says production has been shut down or is in the process of shutting down in Qatar, Iraq, UAE when it comes to offshore. That's one part of it. Then there's the opening of the Strait. What do you think is harder for these companies that are involved, trying to get through their vessels through the Strait of Hormuz or when they have to restart some of this production that they're shutting in?
Well, I think most executives you talk to will emphasize the importance of security for their personnel. So the risks don't have to be very large to stop those vessels from going through. As far as the operational side of the story, these companies are world class. They know how to operate their fields, but that's kind of the point I made in the first response to Jonathan. It's that they're not going to rush to turn things back on immediately. You have to be careful. You have to do this deliberately and very properly engineer to bring production back online.
When it comes to the United States and gasoline prices, we've already seen about 70 cents before the war how much higher these gasoline prices are. At what point do you think the U.S. administration is going to go back into the toolbox and potentially use some other levers? What point, what line in the sand is that for a gallon of gasoline?
Well, I can't give you a per gallon gasoline price that draws the alarm, but there are certainly psychological levels that one sees, 4, 5, above 5. Setting an all-time record, I think, produces something like all-time intervention. But here's what, when we look at it economically and politically, we get different answers. Economically, as a share of disposable personal income per capita, actually, we're not even close to where we were at the height of the post-Ukraine invasion peak in June of 2022, which was about 3.6% of average national per capita DPI going to gasoline. Now we're a little above 2, maybe 2.25%, depending on where prices settle. But that's cold comfort to voters who come into contact with the price on a regular basis. And so the politics of this happen much faster and at a much lower threshold.
Kevin, there's been some discussion about the U.S. Treasury getting involved with oil futures, and a couple of traders have been pointing out that the cost of physical crude is much higher than the cost of oil futures, and is wondering why that discrepancy has widened out. Do you think there already is some activity, government activity, in the futures market?
Theory and reality tend to converge at settlement, so there have been a lot of academic studies about how spot prices and future prices can diverge until they don't. As far as the financial engineering of missing molecules, there are some challenges to that. You have to ask what that means. What are we going to do? If we buy forward contracts to try to provide a virtual reserve, as has been suggested in some of what we've seen reported, then what happens if we're still short when those barrels are due for delivery? We tighten inventories, and that might get priced through. What are the impacts of that? Do we move the intercept, or do we end up moving the forward months higher when there's currently a steep decline, which Kevin Hassett from the National Economic Council pointed out yesterday on TV?
How much of an off-ramp is using the Red Sea? We've heard from Saudi Arabia in particular, possibly diverting more shipments through that passage. Do you see that as a viable off-ramp, or is that just sort of out of the frying pan into the fire?
Well, it raises another risk consideration, which is whether or not the Houthis would be activated either independently or in conjunction with Iran to try to stop those cargoes from moving. Right now, it's a meaningful off-ramp. Right? If we look at the significance of the 5 to 7 million barrels per day of headroom east-west to Yanbu on the Red Sea, that's a pretty significant share of what Saudi Arabia otherwise could put out, and keeps us from losing almost all of the production that would come out of the Gulf. On the other hand, that's a big risk.
We've seen how much trouble the Houthis can cause there, that's for sure, over the last few years. Kevin, appreciate your time, sir. Kevin Burke there of Clearview Energy Partners on the commodity market. Some headlines crossed in the Bloomberg terminal as we've been having this conversation. It's been a busy morning already. The president is putting tremendous pressure, or attempting to put tremendous pressure on NATO allies to get involved and help open the Strait of Hormuz. Had some pushback from Germany, and the UK also distancing itself from this war with Iran. The German government saying moments ago the Iran war is unrelated to NATO. The British Prime Minister, Sir Keir Starmer, speaking just moments ago also and saying the following: we will not be drawn into the wider war in Iran.
But also at the same time, the UK is, we have to open up the Strait of Hormuz. That is not a simple task. So they want to have it both ways. And how are they communicating to their electorate, which many feel like they should be taking a stronger stance against the U.S., especially when it comes to the fact that they've been dealing with this administration when it comes to trade tariffs. The fact of the matter is this is going to hurt Europe more when it comes to energy supplies than it is the United States. Whether they like it or not, they might have to get on board with this coalition.
This headline, Lisa, from the British Prime Minister: the cost of living is foremost in my mind. If you've been tracking the bond market in the UK, we've had a 50 basis point move, 50 plus, over the last month alone. And that's just this month, in March. That's a couple of weeks plus one. A 50 basis point move.
I'm so glad you picked up on that. Keir Starmer also saying that they're taking 5 steps to tackle cost of living. A real question of the policy response to try to stave off some sort of financial crisis for individuals, especially after they've already been facing really escalating costs. How much is that one of the drivers of the long end of the yield curve over in Europe, as you potentially could see the fiscal budget go increasingly toward those cost of living concerns?
The UK getting drawn in to address that problem. We'll get you some details on that in just a moment. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. CEOs of major U.S. airlines are urging Congress to end a 29-day partial government shutdown that has forced 50,000 airport security officers to work without pay. The shutdown already disrupting travel at some major airports as airlines are expecting a record-breaking spring travel period. Meanwhile, President Donald Trump blasting Fed Chair Jay Powell on social media once again, posting courts treat Republicans so unfairly, always seeming to protect those who should not be protected. How is too late Powell not even allowed to be investigated for the horrible job he does? The post coming after a federal judge quashed subpoenas the DOJ issued against Powell. And at the Oscars, one battle after another won Best Picture, and Paul Thomas Anderson took home Best Director. Michael B. Jordan won Best Actor for Sinners, and Jessie Buckley took home the trophy for Best Actress for Hamnet. K-pop Demon Hunters won the Oscar for Best Animated Feature Film and Original Song, Golden. That's your Bloomberg Brief, John.
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. Up next on the programme, clouding the outlook.
We think the Fed is on hold indefinitely. We're now facing what is potentially another prolonged period of elevated inflation coming out of the oil shock. And we think at this meeting there's an underappreciated risk the Fed turns a little bit hawkish.
The Fed decision 2 days away. Jeff Blazek of Neuberger Berman joins us next from New York City. This is Bloomberg. Live from New York City this morning. Good morning and welcome back. Equity futures shaping up as follows on the S&P 500 following a four-day losing streak. The S&P this morning higher by 0.6 on the Nasdaq and by 0.75%, setting the tone over the past few weeks. This move right here, 40% plus move on Brent so far this month. Brent crude this morning behaving itself briefly, 103.11 and just about unchanged on the session. The world's reacting, the president putting tons of pressure on NATO allies to get involved. Germany pushing back, saying basically it's not our war and they won't be getting involved in this war in the Middle East.
Yeah, just one of a number of countries that have really distanced themselves. Japan also saying that they're not going to get involved in this, even though a significant part of the energy that they receive comes from this area. And it's not just crude, it's also liquefied natural gas. There are a whole host of other resources as well. So how long they can say they're going to remain on the sidelines while supporting some of their economies does remain to be seen.
Some of these European countries don't have the fiscal space to get involved. That's problem one. And problem two, they've got to address problems at home. And Sir Keir Starmer speaking just moments ago, addressing the British public, pledging to help them with heating costs. And this is going to become a bigger and bigger issue in the months to come.
Yeah, saying that they're going to support heating costs with some £57 million of extra support. Where is that going to come from? Over to you, Bank of England. How are you going to respond to that? Over to you, ECB, where you've got a 10-year yield over in France at the highest level since 2011. How much fiscal headroom is there given all of the other pledges they've already put out?
Major move in gilt yields over the past few weeks, 50 basis points plus on 2s and on 10s. Under surveillance this morning, clouding the outlook.
We think the Fed is on hold indefinitely. We're now facing what is potentially another prolonged period of elevated inflation coming out of the oil shock. The standard textbook in central banking is that if inflation expectations are well anchored, you ignore this inflation and you focus on the labor market, focus on growth. But it's not clear that they can do that here. And we think at this meeting there's an underappreciated risk the Fed turns a little bit hawkish.
So here's the latest this morning. Policymakers around the world weighing inflationary pressures from the Iran war ahead of a busy week of central bank rate decisions. Jeff Blazek of Neuberger Berman writing the following. We are emphasizing the growth hit more than the inflation impact from oil and commodities. The main thing will be how the Fed thinks about the trade-offs. Jeff joins us now for more. Jeff, good morning. Good to see you.
Good morning.
Thanks for dropping by. 2 days away from a Fed decision this coming Wednesday. The meeting begins tomorrow, a two-day meeting. What do you expect to happen, expect to see in a few days' time?
We expect them to hold, but I think the commentary is going to be really important for us to listen to. That balance that you just highlighted, the growth versus the inflation. To us, it would not be appropriate to address a supply shock in terms of energy costs with policy increases. So we would expect the Fed to try to really allow itself flexibility, though, in its rhetoric this week.
Unfortunately for this Federal Reserve, they have to put out some forecasts as well. There are some people out there believing that maybe they've got a stagflationary twist to some of these forecasts, a revision down to growth, a revision higher for inflation. Do you expect to see the same thing?
We'd consider it a very short-term stagflationary risk. I mean, I don't necessarily think that we would project out meaningful core inflation increases 1 to 2 years in the future. In fact, when we look at inflation break-evens of the TIPS markets, we're not yet seeing it permeate further out the curve, but it's certainly a very real-time risk in the next few months.
There is a sense, though, that the Fed is not going to have the fiscal or the headroom right now to cut rates materially in the rest of 2026. Do you think there are risk assets that haven't fully priced in that reality of potentially lower rates ahead?
Well, I do think that if the rate market, which has been perplexing to us, I mean, you mentioned earlier the Bank of England, the rate increases, ECB, we've seen 50 to 75 basis points on the front end of the curves that are suggesting hikes overseas and far less cuts in the U.S. If that is true, and that is what policymakers decide, then equities categorically have not priced that adequately. And so I do think it's a bit of a juxtaposition we've seen in a cross-asset mindset. But we don't expect this to be. We are now erring on the side of adding duration and being a little more dovish in posture, both in multi-asset and our fixed income portfolios.
Does that mean that you think it's going to be an even bigger hit to growth, or do you think that people are underappreciating the ability of central bankers to look through an oil price shock?
I think look through is the key. So right now, year end, so the front month is very volatile. It's inverted with backwardation. We get all of that. But right now, the market is suggesting we might be at $75 oil at year end. That's pretty palatable. That's manageable. It's like a 10 or 15 per barrel increase of geopolitical premium, which seems fair. But you're talking about a manageable hit to GDP. Maybe we revise downward. Our expectations coming in were 2.5. Maybe that takes us to 2%. That's still very well above trend.
What would change your outlook? You think we would see a bigger hit to growth and potentially some correction in the equity market?
By far, what changes our outlook is prolonged oil above 100 for not weeks but months, and maybe going into the year end. That's where we would suggest that consumer spending is probably going to get hit pretty hard, and it would risk a recessionary type backdrop. Again, though, if that ends up being what happens, our pro-duration stance benefits because we would see rates respond downward due to the growth outlook.
Do you think the Fed could cut in that environment, though, above 100 for months?
Well, I think what you end up risking in that scenario, which is not our base case, and this is a severe outlook that we're theorizing about, but basically what would happen is you would have the double whammy, much like 2007. Remember, crude oil was at 140. Banks were tightening, and then in short order, less than 12 months later, they were dramatically easing because of what happened in that whipsaw.
You've said it a few times now. Bonds are a buy here. Is that just the US, or is that the international bond market too?
No, if anything, we think it's more a buy outside the U.S.
Whereabouts?
Well, we like Europe. We like core Europe because we think that the idea that there are 2 hikes priced in this year is not appropriate. Now, we do worry when you see some of the ECB members talking and they suggest they might have this bias. And by the way, they're dealing with the pressures that you all were just talking about. Politicians are trying to come up with fiscal support to alleviate the consumer pressure. The central banks are a bit nervous about all that. It makes sense. We just think that when this war settles down and gets contained, the central banks are not going to have to be this hawkish.
You know what the pushback would be, though, Jeff, is that the ECB's done it before. They did it in 2008 under Treyz. They hiked with an inflation shock, with a crude price move, not quite like the one we've got at the moment. I think it was closer to 140 than it was 100. And for the Brits right now, we just had the conversation. You suggested it. The Brits are talking about helping consumers at a time when they have limited fiscal space to do so. That would be the pushback this morning. How would you counter it?
That's a fair pushback. I would call it the Groundhog Day scenario. Here we are again. All we can do is express our views publicly, express our views in duration with the comfort. But if they made a policy error like that, we probably would start to pivot more toward the long end because we would see inverted curves. The long end would say, look, you guys are not getting this right.
It would be another reason to buy bonds.
Correct.
Jeff, it's good to see you. Thank you, sir. Jeff Blazek there of Neuberger Berman, thoughtful on fixed income and the opportunity that's opened up now in the bond market to buy.
Yeah, and he's not alone. There are a number of people who are saying that ultimately this is a stagflationary shock. And typically, if you have a short-term pop in oil prices, that reduces growth over the long term. And it should be a buying opportunity for bonds in the long term, which is not what you're seeing. And that has been sort of the conundrum. Is this because of the fiscal potential to really increase deficits? Or is this people believing that you can withstand it because of the strength in the economy and it's ultimately inflationary? Well, his answer, just buy.
You would hope the ECB has learned from its mistakes back in 2008, but then one official speaking in just the past week, talking up the prospect of acting before people think.
One commentary that I was reading said that not only is the ECB dealing with a fiscal shock, not only are they dealing with an oil price shock, but they're dealing with fragmentation as well. So they also have to deal with some sort of splitting and splintering of some of their base groups in terms of their approach and their opinions.
So as the trading week begins, let's set the scene for you. Crude still around triple digits on Brent, WTI at 97. The president pushing allies to step in and help him reopen the Strait of Hormuz. And allies so far this morning, the UK and Germany, pushing back,
throwing some cold water on this idea that they want to get involved in what is going on in Iran and the Strait of Hormuz. What's interesting, though, is the EU's foreign policy chief did talk about the fact that member states potentially could be moving the Red Sea naval mission they have right now to protect cargo in the Red Sea that's been going on for months. Maybe they can move that to the Strait of Hormuz. Politically, though, this is going to be incredibly challenging for some of these European countries, not to mention the fact that Australia, Japan have already come out and said the threshold is very high for us to do so.
It's a very fast-moving financial market, that's for sure. It's fluid, I think it's fair to say. Crude rolling over just briefly, and as it does, equities break out to session highs, up 0.75% on the S&P 500. Up next, we'll catch up with Stephen Parker of JPMorgan, Henrietta Treyz of Veda Partners, Francisco Blanch of Bank of America, and Vishal Khanduja of Morgan Stanley. The second hour of Bloomberg Surveillance is up next.
This is clearly a massive shock for now.
People see the shock. They think the U.S. economy is well positioned to manage it.
The longer it goes on, the higher the risk that this one-time price impulse gets kind of normalized.
Globally, this is more of a risk to growth rather than sign of some sort of recession.
For now, the Fed is going to be cautious.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures, after declining for 4 consecutive sessions on the S&P, we bounce by 0.75%. On the Nasdaq, up by 0.9. In the commodity market, a 40% plus move on the month in crude. We pull back just a third of 1%. Brent at 102.85. Going into this week, a Federal Reserve meeting. 2 days away, that decision just around the corner. On deck also, the ECB, the Bank of England, and the BOJ.
Yeah, and arguably some of the other meetings, other than the Fed, could be more interesting because the strain that they're feeling is coming on 2 different sides. On one hand, they have a bigger energy shock than the United States does. On the other hand, there is even more pressure coming from different governments to pay for some of the offsets that a lot of consumers will need in order to cope with the cost of living hit that they are feeling. We saw that this morning from the United Kingdom. You put all this together, how does the ECB, how does the Bank of England respond? Do they even entertain hiking rates?
It depends how long this goes on for. How many times have you heard that over the past 2 weeks? It depends how long this goes on for. Crude higher over the past 2 weeks, and these central banks might need to respond sometime soon. With language or with action. And let's hope it's not with action, because that could be a major policy mistake. This is the headline we're getting out of the UK at the moment, on a coalition coming together to do something about reopening the Strait of Hormuz, which many people in the commodity market describe as somewhat as an impossible task at the moment. Hormuz defence needs as many partners as possible. The words of the British Prime Minister just moments ago.
But no one is running. No one is running to make sure that their naval is out there in front, going through the Strait of Hormuz in this coalition that the president is talking about. Japan, Australia already said we're not going to do it. China has yet to respond. And what you have from the European Union is this discussion potentially of their naval fleet they have in the Red Sea moving to the Strait of Hormuz. But then when you look to the individual leaders like Keir Starmer, like Frederick Merz, they're basically saying not so fast. They don't want to touch this right now with a 10-foot pole.
You break it, you own it. Fix it. Seems to be the response from some NATO allies at the moment, whether they feel the repercussions of it or not.
So Luxembourg's foreign minister had this to say: blackmail is not what I wish for. Then you had this UK official saying, it's also important to remember that we have not sought to be a protagonist in this war. So definitely a feeling of not wanting to get involved.
I think an important comment this morning comes from the Iranian foreign minister. The reason we say we do not want a ceasefire is not because we are seeking war, but because this war must end in such a way that our enemies never again think of repeating these attacks. When analysts come on and continue to say that their worst case scenario is that this is prolonged, that is basically the base case for people that are living in the region and are touching this story every single day. Because of this reason right now, they took out the Ayatollah, they took out the top brass, they went after Karg Islands. Right now, it doesn't seem like the Iranians feel like the U.S. has suffered enough.
Market participants called it a risk. The Iranians called it a goal. Right now, Brent crude around triple digits, Brent at 103 and just about unchanged on the session. Coming up this hour, Stephen Parker of JPMorgan Private Bank as crude adds to recent gains. Henrietta Treyz of Veda Partners as President Trump demands support in the Strait of Hormuz. And Francisco Blanch of Bank of America with the White House forecasting a dip in energy costs. We begin this hour with stocks pushing higher on the S&P 500 by about 0.7%. Stephen Parker of JPMorgan Private Bank with a 7,400 to 7,600 year-end S&P target and writing the following: we've not changed our base case forecast for growth, but acknowledge increasing downside risk the longer energy prices remain elevated. Stephen joins us now for more. Stephen, good morning.
Morning.
It's good to see you. So let's talk about what we've seen so far. 5% move on stocks. 60 basis points of widening on high-yield spreads from the tights of the year so far. Is that a sign of resilience or complacency?
You know, I do think the markets are probably a bit complacent given the move that we've seen in energy markets. We've always said to clients, when it comes to geopolitics rarely have long-term impacts on markets, but we have to acknowledge that particularly when energy is at the center of the storm here, they can certainly have a bigger impact on markets in the short term. You mentioned the pullback that we've seen in the U.S. We've seen a bigger impact in international markets, particularly in places like Europe and Asia, who are more exposed and more at risk to these higher prices. But there does seem to be a bit of complacency in markets.
Where do you see that complacency concentrated at the moment?
Well, I think that investors are just looking at the fact that the expectations for energy prices are to recover and be back around $80 in the not too distant future. And in that sort of world, then we can get back to the fundamental story around U.S. equity markets and double-digit earnings growth, which is what we expect. The challenge is if we end up in a situation where we're looking at triple-digit oil, not just for the next month or two, but for the next 3 to 6 months, then you have to start asking yourself about the outlook for growth and the outlook for inflation.
Are people more accurately pricing in that perspective internationally? You talked about the hit to international markets.
Well, I think you're seeing two things. One, places like Europe and Asia are more exposed to higher prices in the near term, and the risks of those prices remaining higher are there for a longer time period. The U.S. is buffered by a greater sense of energy independence. I think you're also seeing a bit of a flight to safety, a flight to quality. You're seeing it in the rally in the dollar. You're also seeing it in the recent outperformance of tech. Not too long ago, we were talking about tech being under pressure, the rotation into more cyclical parts of the market. I think investors are looking at this environment and saying the long-term structural fundamentals, the earnings growth, the upgrades that we're seeing in the tech sector, and that's bringing money back into the U.S. and supporting U.S. equity markets.
Do you think this has materially shifted the narrative that took hold in the first 2 months of the year, which is diversify outside of the United States, diversify outside of tech? Has that pulled it full circle and actually caused the leadership to come from the United States and from big tech?
I think perhaps in the near term, but I do think that longer term there is still that diversification story. In particular, we think there are interesting opportunities in emerging markets who have been hit the hardest in this recent move higher in oil prices. But still, there's a really interesting story, particularly in Asia, around the tech story there, the hardware sector. We've seen massive earnings upgrades in places like Taiwan, Korea, India. We think that story continues, and we're looking to build a shopping list with our clients to say, if this volatility continues, what are we thinking about adding? Emerging markets would be squarely in that bucket.
At the top of the shopping list over at Neuberger Berman, just on the programme moments ago, the bond market. They believe all roads lead to lower bond yields here. Even if you fix this crisis over in the Middle East, lower bond yields. If you don't, lower bond yields. Because if you don't, ultimately, it's going to hit growth and yields at the long end of the curve are going to roll over. Is there an opening here in the bond market?
You know, our view around rates is that we're probably more range-bound. We came into this year a little bit more conservative than the market. We thought we would see one cut from the Fed. That's still our base case view. The challenge is going to be this push and pull between potential for lower growth and potential for higher inflation. That's why it's going to be interesting to listen to what we hear from the Fed this week as they try to set the narrative, as they try to guide markets in terms of which one they're going to prioritize. I still think that there's room potentially for another cut, but we don't think necessarily that rates are going to move meaningfully lower from here.
How do they guide the market in this moment when, in the past, when we saw energy price spikes, they just called it transitory and they were wrong?
Yeah. Well, I think what's going to be interesting is to listen to their comments on not just energy markets, because I think those are more difficult to prognosticate, not just for us, but also for the Fed. I think it's going to be interesting to listen to what they say about labor markets. Obviously, recent data has been a bit weaker than what we would like to see. The question is going to be about not just sort of the demand for labor, but the supply of labor. And if they indicate that that is front and foremost, the top of their mind, that could indicate that they're willing to let inflation run a little bit hotter at the expense of supporting labor markets.
You mentioned semiconductors, some of these companies you like. Have you thought about other issues with the Strait of Hormuz besides oil? Helium. A third of global helium goes to the Strait of Hormuz. That is needed when you make semiconductors.
Yeah, I mean, what we're seeing, everyone is looking at the first order effects, which is higher energy prices, higher gasoline prices. But as you pointed out, Annmarie, there are long-term meaningful impacts around supply chains, broadly speaking, in different industries around the world. And the challenge is, if these things get turned off, they don't just get turned on with a flip of the switch. One of the themes that we've been talking about a lot with clients is this idea of the shift from globalization to global fragmentation, and the idea that countries and companies are going to be more concerned about supply chain resiliency rather than supply chain efficiency. And so one of the areas of focus has been on this idea of national champions in strategic industries as the U.S., as Europe, as Asia look to develop these national champion companies in places like power and infrastructure, security and defense, and technology.
I'm going to ask you a really unfair question, so brace yourself and forgive me. Forgive me for doing this. But as I sit here and listen to this and you bring up chips and we're talking about geopolitics, a lot of this is scenario analysis, but I think it's a scenario that we need to explore. How would you react if China used this as an opportunity to go after Taiwan?
I think that question is coming up more and more in our conversations.
What do you say back to clients?
I think we have to acknowledge that it is a significant risk, and I think that markets would react more aggressively to that type of news, even than what we're seeing as it relates to energy prices. I do think at the end of the day, there is still an economic agreement amongst the world and the impact that might have on the economy. probably reduces some of the risks there, but it's a risk that we need to acknowledge. And at the end of the day, when it comes to geopolitics, we don't manage portfolios around tail risk scenarios. In the long run, that's a losing strategy. It's why we lean into diversification. It's why we think about global investing, stocks and bonds, but also diversifiers in a portfolio related to higher inflation, which has been top of mind for our clients.
And that's the risk. It's because those supply chains aren't diversified enough right now. Stephen, it's good to see you. Thanks for being here. Stephen Parker there of JPMorgan Private Bank. It's a conversation coming up with clients. It's a conversation I'm hearing as well over the weekend.
Yeah, especially because there were Chinese ships that were getting close and doing some war exercises near Taiwan, according to a number of reports. There was a question of whether this was actually going to come to pass. As I listen to this, I do wonder how you can get the confidence to lend longer term to companies. If you're dealing with this number of variables and this number of potential tail risks, wouldn't you charge a higher premium? This sort of speaks to the question of at what point do you have to start seeing a risk premium baked into credit markets, not only commodities markets, to reflect some of these potential scenarios?
It's a great point. And for a lot of people, it feels very existential because while the U.S. is focused and their Navy is focused on the Middle East, China right now potentially could make a move with the U.S. unable to respond. Now, Xi Jinping has to weigh other things the president could do, and some of them could be, the nuclear option, literally a nuclear option. But this is something that continues to come up. And our stock market is 90% tethered to Taiwan because of how important hyperscalers and these tech companies are to our S&P 500.
Probably not the conversation you wanted to hear this morning, so again, forgive me. Equity futures on the S&P positive by 0.7% with an update on stories worldwide this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. The key port of Fujairah in the UAE was hit by a drone this morning, halting oil exports. It's the latest in a series of strikes threatening the country's only export route. Fujairah is a major hub for both crude and fuels. It has taken on increased importance for global markets because of its position outside the Strait of Hormuz. U.S. allies responding to President Trump's calls to form a coalition to support safe passage through the Strait of Hormuz. UK Prime Minister Keir Starmer saying efforts to reopen the strait won't come as a NATO mission, but the UK will work with partners on a plan. A spokesperson for the German government also saying Germany won't provide military support in Iran, calling the war unrelated to NATO. And Meta will pay as much as $27 billion over the next 5 years for access to AI infrastructure from the cloud provider Nebius. Nebius is set to give Meta $12 billion of dedicated capacity starting early next year. Meta is building a portfolio of massive AI partnerships, including with NVIDIA and AMD. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Appreciate it. Look, when I say this, I understand people on Wall Street are blessed. They just have to price risk. They just have to price war risk. They don't have to fight it. It's a very, very different story. So take this comment with a pinch of salt. This from Peter Bookvar, publishing just moments ago. Is it Friday yet? That's the sense of things on Wall Street, right? It's like no weekends anymore. Is it Friday yet?
Try keeping up. And not only is it not weekends anymore, but I keep saying it feels like 52 pickup, where someone's throwing up all the cards and then saying, try to find them all and put them in order. And you're just sort of in this role of, trying to put this all in some sort of incomprehensible order.
Monday morning on Wall Street. Is it Friday yet? Up next on the program, securing the strait.
The whole world will be united on the need to open Hormuz, and clearly we will have the support of other nations to achieve that objective.
Up next, Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Three-week losing streak on the S&P 500. Haven't had one of those in 12 months. Responsible for 2 weeks of that, this right here. Brent crude, 102.83, just about holding on to triple digits and pulling back by a third of 1%. WTI breaking 97. We're down by 1.8% on the session. In the equity market, near session highs. On the S&P, the Nasdaq and the Russell. The S&P up by 0.7. The Nasdaq higher by 0.8. Likewise on small caps this morning. Under surveillance this morning, securing the strait.
The world depends on the flows through Hormuz, and most importantly, the Asian nations, Japan, Korea, China, Thailand, India, A meaningful part of their total energy supplies come from the Straits of Hormuz. So, of course, the whole world will be united on the need to open Hormuz, and clearly we will have the support of other nations to achieve that objective.
So here's the latest this morning. The president demanding other nations help open the Strait of Hormuz with crude holding above $100 a barrel. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John. Good morning. Well, as disruptions continue, the White House intensified its calls over the weekend to reopen the Strait of Hormuz. And new within the last hour, a NATO official in an emailed statement to Bloomberg News does confirm that individual allies are speaking directly with the U.S. about what more they can do, including in the context of securing the strait, though it appears that allies still remain wary. We heard from the UK Prime Minister Keir Starmer just moments ago, a headline crossing, where he said that the effort to reopen the strait will not be a NATO mission. President Trump told the FT in an interview over the weekend that the NATO alliance would have a, quote, very bad future if allies did not help out. And that's not the only threat that we've seen lobbied from the president in recent days. He also threatened to delay his planned visit to Beijing, set for the start of April, if China does not come and send ships. According to data analyzed by Bloomberg Economics, nearly 38% of total oil flows through the strait do go to Beijing, but our own analysts say that it is unlikely that we would see China send ships, due in part to the fact that some of the vessels that are getting through the waterway right now are headed towards Beijing, and the country also has a vast stockpile from the past few years. The Wall Street Journal did report over the weekend that we could see a coalition announced as soon as this week, but at this point, it's unclear what that would actually look like and when it would take place, either before or after the conflict resolves. John, in terms of other threats, President Trump is now saying that the U.S. could target energy infrastructure if disruptions through the Strait of Hormuz continue. As you well know, the U.S. confirmed that it had hit military targets on Karg Island on Friday, the country's top oil export hub.
Tyler, appreciate the update. Tyler Kendall there from outside of the White House. Tyler, thank you. Henrietta Treyz of Veda Partners has this to say. Permanently securing the Strait of Hormuz will likely require a sustained presence to override Iranian weaponization on the economic front. Henrietta, welcome back to the program. The financial asymmetry is pretty obvious here. It's costing America a lot to fight this war. Just how much is this costing?
Over $1 billion a day, over $200 million a day for Americans buying gas at the pump. And I think there's just this uncertainty overhang, this cloud that markets hate so much, as the president gets sort of increasingly hysterical with regards to our NATO allies, whether it's the UK or Germany or France, Spain, just going after them in ways that remind me a lot of 2025, except now he doesn't have tariffs. And I think it's striking that just 8 days before they started bombing Iran, the Supreme Court took away the president's tariffs. And it seems obvious to me that he misses those IEEPA tariffs quite a bit. I think it'd be a different situation if he still had them. So, his Twitter posts going after it, as extreme and dramatic as they are, really underscore how much he misses that cudgel that he just doesn't have anymore.
Henrietta, an energy shock in the United States is never good for U.S. president. It's even worse in election season. Right now, you have the national average $3.72 per gallon of gasoline. In California, already above $5 a gallon, potentially going to $6 sooner rather than later. What could the administration and Congress do when it comes to protecting Americans at the pump?
There's not a lot. There's actually, that's the wrong way to say it. There are a lot of little things. So they can change the ethanol blending rate to an annual blend instead of exceptions for certain times of the year. They can release some of the SPR. They can change the Jones Act. They can continue jawboning the way that the president is trying to do about victories in Iran and how everything is going swimmingly. But the reality is you need the Strait of Hormuz to be reopened. And we need, for example, military ships from France that have anti-mine capabilities. We need the divers in France that have the anti-mine capabilities. And the president is just not getting those allies on board with this war of choice that he has decided to engage in. And the extremes that he is trying to push on them are just not working. As I mentioned, you can feel the absence of the tariffs.
Some of the other tools the president also has is maybe an export ban when it comes to U.S. crude and crude products, as well as gasoline price caps. What would Congress say to that?
Yeah, I think the export ban is really interesting. I get that question a lot from clients. I think it's counterproductive, though, because obviously the problem is not domestic. We have a lot of energy production. We have a lot of supply. We have shale revolutions. We have alternative energy sources. It's getting the oil around the globe to places that are extremely exposed to Iran. That's the problem. So I think restricting exports would, while it sounds good, be counterproductive in the long run. And I think that would frustrate the White House. So I'm not expecting to see that. Congress, for its part, I just spent a week up on Capitol Hill. I don't think they're ready to address the war in any kind of material capacity. I think we're going to have to get past the spring recess, which basically puts us into mid-April, before they start to act on actual legislation around another government stimulus package. The farmers are going to need a second bailout. It's not just oil. It's all the fertilizer, as y'all well know. They're going to need another $15 billion, and the USDA is working on that. So I think we are probably at a situation where it will be at least 3 weeks of the continued war before we see any action from Congress. They're much happier to not focus on this, and they're going to be happy to go on recess.
Henrietta, I don't mean to be snarky, but are they prepared to do anything on anything in the next couple of months?
No, definitely not. And I don't think it's snarky at all. I mean, the president and the Republican conference are at very different loggerheads when it comes to the Road to Housing Act, when it comes to the crypto legislation. And the president stressing at the Republican retreat last week that he wants to focus on the SAVE Act, which is associated with mail-in balloting and transgender sports. We do not have a package that is moving through the Senate that can also pass the House, that can also get the president's signature, and they don't have an agenda list either. So the entire thing really, I think, rests on a DHS reopening package. We're on day 30 or whatever of a DHS shutdown. They're going to need to address that, but I don't think it's going to be until after the spring recess. So the whole agenda, I think, is suspended and will be for the rest of the year.
So you don't think that DHS and that sort of partial shutdown that's getting people in lines and waiting forever when they go to the airport is going to get resolved? I just wonder if in some ways Congress has absolved its role as an equal power with the executive branch. But if we've seen a fundamental shift that will not go back to where it was before?
Absolutely, Lisa. I mean, I think that we saw that all through 2025. And everybody's just waiting to get through the midterms. The popularity of President Trump with his voters is so overwhelming that Republicans do not have an opportunity to step outside the lines. With a couple lone exceptions, I would say Senator Tillis, who we had the opportunity to sit with for an hour. He is seriously going against the president's agenda. The social media post the president put out about the Federal Reserve Chairman is not going to land well with Senator Tillis. And he is absolutely living his best life right now, having a great time standing up for the Fed and saying, we want Fed independence. I want this entire case thrown out. I want it, completely eliminated. And I will stay in this seat until January 3rd of 2027, making sure that that ends up happening. And I think he's raising the odds that Jay Powell stays on after his replacement is confirmed, just to make sure that sticks.
Yeah, just to echo that, based on our conversations with the senator from North Carolina, seems like he's having a good time at the moment. Henrietta, thank you. Henrietta Treyz there at Veda Partners. As we've been having this conversation, an update from the UAE on oil production from the team and some reporting elsewhere as well. Production there for crude has fallen to about 2 million barrels per day. That was around 3.5 million. Around 3.5 million before this war broke out.
And we're just 3 weeks in, so potentially this number can actually get a lot smaller, which is why when the IEA comes out with 400 million barrel a day and stockpiles being released, it is not enough to fill the gaps that we are seeing right now.
Equity futures this morning positive by 0.7% on the S&P 500. In just a moment, we'll talk about crude with Francisco Blanch of Bank of America on the growing threat to global energy supplies. Plus, Danny, how's your morning movers? Meta moving higher on some big reports of some big layoffs. That stock is higher by 3%. Crude looks like this morning. Brent after a 40% move so far this month. Brent and WTI shaping up as follows. Brent crude at the moment 103.65, just about positive by 0.5%. In the equity market on the S&P 500, holding on to gains following a 4-day losing streak up by 0.6%. Plenty of Monday morning notes are dropping, including this from Mike Wilson over at Morgan Stanley. Lisa, the bar remains high for the oil spike to threaten the business earnings cycle, while we can't rule out modest downside in the near term if the the rate of change on crude and the dollar accelerates further, we maintain our view that this correction is closer to its ending stages in time and in price.
Yeah, they're not alone. There are others as well, including Goldman Sachs and others who have come out and said something similar, because the U.S. economy is more immunized from any kind of oil price shock to the downside. And frankly, there's a lot to like, and people keep pointing to that. We were bullish just 2 weeks ago. Do we really have to change everything all over again?
A 5% move on the S&P 500. Is that your dip? Is it time to buy? Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, I want to start with where the oil majors are trading this morning. They still are moving higher, even though NYMEX crude is to the downside this morning. Exxon and Chevron. Chevron has been up some 5% since the war started, to close Friday at a record. Exxon closed just under a record. That's up less, about 2.5%. Some of the other corporate news we are tracking: Reuters reporting that Meta plans to lay off staff. It could affect about 20% of them. The idea is to funnel those savings into AI infrastructure spending. They're going to be spending about half of their revenue on capital expenditures. So a lot of maybe efficiency Mark Zuckerberg wants to bring back to the company. Those shares up 2.5%. And then the other side of this trade is Meta signing one of their biggest ever single contracts with Nebius. This is a neo cloud. It's worth about $27 billion over the next 5 years. Nebius is going to provide them with about $12 billion worth of space in their neo cloud. So those shares moving 14.2% in the pre-market, John.
Danny, appreciate the update. More from Danny in the next hour. On our radar this morning, Apollo executive John Zito calling out, quote, arrogance in private markets and blaming the media for creating a frenzy around private credit. According to audio obtained by the Wall Street Journal, Zito believes his firm is on solid footing. Elsewhere, the president saying Iran wants ceasefire talks. Iran's foreign minister refuting those claims.
No, we never asked for a ceasefire, and we have never asked even for negotiation. We are ready to defend ourselves as long as it takes.
Tehran launching fresh attacks across the Persian Gulf as the war enters its third week. And finally, the world's largest single-site aluminum smelter is cutting output as shipping through the Strait of Hormuz stalls. Aluminum prices on the LME, the London Metal Exchange, briefly jumping to the highest level since 2022.
It's important to remember we're not just talking about crude when we're talking about the Strait of Hormuz, and the story really highlights that. Yes, it's aluminum, but as we were talking earlier and Annmarie mentioned, it's also about 30% of the helium, which is a key ingredient to semiconductors, also travels through there. Also 30 to 50% of the world's urea, which is a key nitrogen ingredient in fertilizer. Also, of course, about a quarter of LNG, liquefied natural gas. So we're not just talking about an oil shock. We're talking about a whole slew of commodities that are also getting severely impacted.
Well, it's not just this aluminum smelter. It's also Total Energies overnight talking about some of the production they need to unwind in some of these countries. On top of that, when it comes to countries like India and places in Asia, which is really on the front lines of getting hit when it comes to an energy shock, liquefied petroleum gas, what they use to cook their meals with. There was a story over Bloomberg over the weekend, the fact that a number of Indian weddings, these wedding venues had to go out and tell brides and grooms, we're going to have to cut back on the menu because we cannot afford right now where prices are and we don't have the stock when it comes to this gas we need to make this food. It is incredible what is going on right now, and it's not just the crude complex.
It's getting serious, that's for sure. I just want to issue a quick correction. I've lived here more than a decade. I love this country, forgive me. Aluminium. Every time I say aluminum, I just don't feel good. It's particularly aluminium on the London Metal Exchange.
You know,
right? Just to...
I think that it's fair. I think it's fair for you to say aluminium.
You'll give me whatever that was.
But it wasn't. Aluminium or aluminum. But it wasn't worth the correction. It's just a difference, an alteration.
Adidas, Adidas.
My brothers and sisters over there might be getting, you know...
Really upset?
Upset,
might
maybe.
Make Thanksgiving
the
different.
family group chat.
Brent crude climbing over $100 a barrel following President Trump's threat to extend attacks on Iran's oil hub. The NEC director, Kevin Hassett, dismissing concerns about elevated energy prices.
You can also look at futures markets, which are interesting because you've cited over and over the spot price of gasoline, which of course is affected right now by the disruption of the Strait. But if you look at the futures prices, they're expecting a rapid end to this situation and much lower prices. In fact, I don't think I've seen a sort of future price path with as steep a decline in all my years watching futures.
Francisco Blanch of Bank of America writing this: Brent could well average $100 a barrel for the year if the war impacts oil balances significantly into the third quarter, and could average near $130 if the disruptions extend into the fourth quarter. Francisco joins us now for more. Francisco, welcome to the program, sir. I want to start with a key assumption of yours in your research. We do not embed any permanent supply loss from this war. Francisco, why is that line so important?
Thanks for having me, John, and great to see you again. It's very important because if we end up with some meaningful destruction of energy assets, we're going to see forward points increasing very quickly in the curves, right? In these curves that Mr. Hassett was referring to in his comments. So, of course, we've seen Hark Island, Iran's main oil loading terminal, been struck over the weekend, and there was a clear point made that energy infrastructure was still intact, even though military assets had been specifically targeted. So I think it's very important, but of course, in wars, as you know, it's difficult to find sometimes a closure, and you know, we are always one step away from a major escalation on the energy side, and that's, I think, the fear the oil market has.
There are supply chain realities, though, that we could discuss right now. If you shut in production, how hard is it to restart it and get back production to where it was before?
Well, I mean, I think there's some concerns around that, but again, most oil fields across the Middle East are conventional. So I would expect a lot of the production to come back relatively quickly. Refineries are another point of concern. We saw the Tehran refinery, or at least Tehran refinery fuel depots being targeted. The refinery itself is unclear what's its current status. But I think generally most assets should be able to come back within a month to 2 months, if and when the war ends. And now, having said all that, another key assumption in our numbers is that Hormuz is going to be reopening sometime soon and recover the majority of its traffic, which might also be maybe too far-fetched an assumption. That's one very, very important concern. Hormuz, as you pointed out, is the choke point for a lot of the commodity flow in and out of the world.
Francisco, do you have a day circled on the calendar this week, to John's point earlier, where you start to challenge some of your assumptions and shift to some of the $130 a barrel base cases?
Well, look, I mean, we know the Houthis were able to disrupt traffic in Bab el-Mandeb for about 28 months. So I want to remind everybody of that. Flows were down from around 9 million barrels a day to 4.1, 4.2. Now, the difference between Bab el-Mandeb and Hormuz is that there's clear alternatives that allowed shippers to reroute those 70 vessels that used to cross. A lot of them rerouted through the Cape. So that was, I think, a big relief valve for Bab el-Mandeb. Here, there's no clear rerouting. So I think the options are not great to reopen the strait, particularly in the light of all the capabilities that Iran might have, and also. To be honest, this quickly becomes a bit of a guerrilla war like we saw in Yemen, and I think shippers themselves will be very, very cautious not to take that route if there's risk of their vessels ending up in fire. And we've seen 20 of those already being attacked or so, I think. So it's a difficult time for shippers, for insurers. Everyone's kind of waiting for a resolution, but if it doesn't come up in the next few weeks, I mean, I'm going to give it maybe until the end of the month. Things can get very, very complicated for oil prices.
We had Jeff Curry of Carlyle on last week, and he was talking about how even if the Strait of Hormuz is opened this week or next week, there is going to be an extra risk premium placed not only on oil, but a whole bunch of different commodities, partly because there'll be nations that are stockpiling, akin to what China has done, and partly because people will understand that there is that risk of transporting goods on the seas. Do you agree with that thesis?
Yeah, I think the war is gonna transform the way we think about commodities more fundamentally. Remember, in the 1990s, Japan pushed for just in time, and in the 2020s, it's been China's just in case. strategy of inventory accumulation. So they've been building up huge oil reserves, and we've seen, obviously, in part because of trade tensions, in part because of political/military tensions, we've seen a big buildup in commodity inventories. I think this trend only speeds up once the war's over. And I think that provides support to long-dated commodity prices sooner or later, and we'll see, I think, a bit of a mad rush once we are out of the war. But again, we need to see this war coming to an end, because if we don't, I think the risks of recession will grow by the week as we head into April. And definitely, if we are still in the same place in May, looking into a third quarter, I've already mentioned we could see spikes to $160 a barrel. If things keep going, we could see Brent breaking $200 a barrel. I think it may take a little longer to get there, but it's important to understand that we don't have that much time, and obviously the U.S. is a little more insulated than other regions, but I think in particular Europe is very, very exposed, as are many other Asian countries, particularly Northeast Asian countries.
Francisco, I know that you track what is going on in terms of the OPEC countries, and we've learned this morning at Bloomberg that the UAE production has fallen to about 2 million barrels a day. It was closer to 3.6 in February. What other countries do you see production really falling off a cliff when it comes to the Gulf?
Well, so it is known that Iraq has been curtailing output, as has Kuwait. Remember that, we think probably about 10, 11 million barrels a day of production has been curtailed in the past 2 weeks. So that's about 10% of the world's supplies. About 20% is what passes through Hormuz. So we've seen about production about cutting about half. The other big issue, I think, is refined petroleum products. Refineries have been shut down across the board. And the issue with refineries, as you know, is we don't really have a strategic petroleum reserve for petroleum products. We have it for crude oil, so it's a little bit mislabeled. The strategic petroleum reserve is really a strategic crude oil reserve. So if we lose refining capacity, that impacts petrochemical units. You pointed out the weddings in India for LPGs like propane, and honestly, like it's. The supply chain dislocations that are building up in the background are gigantic. I mean, remember, 1% of energy is roughly 1% of GDP. So if you take out 10 percentage points of oil, and oil is about a third of energy, plus obviously we're losing on gas, we're looking at potentially 7 or 8 percentage points of energy sucked out the world's system right now, and that's going to have a big knockdown effect on GDP very soon. If that disruption doesn't get resolved.
I'm glad you brought up products, because a lot of the conversations I had over the weekend was centered around jet fuel, diesel, LPG. When it comes to these Gulf exporters, are they having to start to pick and choose what they're going to export? What's the most important for the global economy?
Well, we are seeing very little petroleum, in terms of petroleum products flowing through the Gulf. I mean, my understanding is whatever has been flowing has been Iranian crude oil, to a tune of 1.5 to 2 million barrels a day. And again, those are crude vessels heading for China, which I think sets a very interesting next set of days with Harg Island now being a bit in limbo. But also importantly, I think the petroleum products are already experiencing huge distress. Jet fuel prices are $250 a barrel already, right? So we've seen that, and we've seen, in fact, Dubai crude oil over $150 a barrel. Again, that's crude oil for delivery in the Persian Gulf, and of course we know China has actually banned the export of petroleum product fuels like gasoline, jet fuel, and diesel, which is in part exacerbating this problem. So I think the question is, who else is going to do it? Who else is going to preserve or limit those petroleum product exports? And of course, we know who is most dependent on those petroleum product exports. Number one exporter in the world of petroleum products, America, 7 million barrels a day. So not a bad time for U.S. refiners, but obviously a point of concern as those petroleum fuels that are being exported also impact domestic prices for gasoline at home in America. So lots of question marks as countries go on to protect their own market.
Francisco, always good to catch up and get some clarity from you, sir, at a very volatile time. Francisco Blanch there of Bank of America on the broader commodity market. The latest on China, a big factor here. The president spoke to the Financial Times over the weekend and said this about China. I think China should help too because China gets 90% of its crude from the Strait of Hormuz. Before going on to say that we need to address these issues and ultimately he might have to delay his trip to China, which was set to take place in the next couple of weeks. The Treasury Secretary has been meeting with his Chinese counterpart over the weekend in Paris in preparation for that get-together, that meeting over in China. And this is what the Treasury Secretary had to say to the American press just moments ago. If you're connecting those stories, don't. It's false to say if China doesn't open Hormuz that the trip will be delayed. If the president delays the China trip, it would be due to prosecuting the war. The Treasury Secretary just moments ago.
So he's trying to put some distance between that trip and what is going on right now with the Strait of Hormuz and the fact that the president is coming out and saying that he is demanding, saying it is appropriate last night, that people who are the beneficiaries of the Strait will help to make sure that nothing bad happens there. The biggest beneficiary of the Strait of Hormuz is arguably China, with Iran's exports 90%, 95% going to Beijing. But the Treasury Secretary is trying to put a gap in between almost what the president threatened last night when it comes to Air Force One in that interview with the Financial Times.
Besson doing what Besson does, which is calm things down. Just a little bit. Crude right now, 103 on Brent, WTI 97, with an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. As Annmarie mentioned, the UAE's daily oil output has been cut nearly in half. Reuters reporting crude production has fallen to 2 million barrels a day from over 3.5 million in February. The Iran war and the effective closure of the Strait of Hormuz has forced widespread production cuts both on and offshore. Elsewhere in the UAE, Dubai's main airport resuming operations after a drone attack sparked a fuel tank fire that suspended flights. State-owned carrier Emiratis restarting a limited schedule after a more than 7-hour ground stop. The world's busiest hub for long-haul flights suffering 3 disruptions since the war began. And here in the U.S., FCC Chairman Brendan Carr threatening the licenses of major media broadcasters. In a post on social media, Carr writing broadcasters that are running hoaxes and news distortions have a chance now to correct course before their license renewals come up. Carr's warning follows a post from President Donald Trump complaining about coverage of the U.S.-Israeli strikes on Iran. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara in about 30 minutes' time. Up next on the program, short-term pain for long-term gain.
The conflict will come to the end in the next few weeks, and we'll see a rebound in supplies and a pushing down of prices after that. This is short-term pain to get through to a much better place.
Up next, Vishal Khanduja of Morgan Stanley from New York City. You're watching Bloomberg TV. Getting a real-time update on crude production from the team here at Bloomberg. So according to sources familiar with the matter, Kuwaiti oil output has fallen to about 1.3 million barrels a day. Before the war, that was 2.6. That's the latest on Kuwait. This is the latest on UAE. Oil production there has fallen to about 2 million barrels per day versus 3.56 back in February before this war. Just gives you an idea of how much production has been cut in certain places by about half. Brent crude right now positive by 0.2%, 103.34 on Brent, WTI at about 97. We've started to calm down just a bit in the commodity market. In the equity market, it looks like this. Equity futures on the S&P 500 positive through the last few hours, positive by 0.75%. Under surveillance this morning, short-term pain for long-term gain.
I think that this conflict will certainly come to the end in the next few weeks. Could be sooner than that, but the conflict will come to the end in the next few weeks, and we'll see a rebound in supplies and a pushing down of prices after that. This is short-term pain to get through to a much better place where the Middle East can no longer be held hostage by the one rogue nation in Iran.
So here's the latest this morning. Rising oil prices and the threat of higher inflation leading investors to scale back rate cut bets. Vishal Khanduja of Morgan Stanley saying the onset of the war changed the dynamics. The stagflationary shock will delay central bank easing and inflation will cause further macro dispersion. Vishal joins us now for more. Vishal, welcome to the program. Ultimately, what does it mean for this Federal Reserve as they get together down in Washington, D.C. tomorrow?
Morning, John. Thanks for having me on. Interesting times that we live in. not just inflation shock. I think we are seeing a growth shock as well that will probably subsequently follow. We've seen how history is proving to this or guides us towards this. Countries that are going through or regions that are going through this one right now and are oil importing or energy importing will feel that shock quite significantly. Countries or regions that are net exporters like the US, yes, we will feel it. It's painful, but it won't linger in the economy for long periods of time. But growth shocks on the negative side will be felt. So this week is a tough one for the Fed as well as the other central banks. I think it's easier for the Fed versus the other central banks, to be honest. But yes, I think a little bit more direction and no action this week.
Vishal, do you think that this is an opportunity to buy longer-term bonds if you believe this is going to be more of a growth shock and not necessarily a longer-term inflation shock?
We do think that way. I think around that 10-year, 7 to 10-year point of the yield curve does provide you quite a bit of protection, both from a growth shock subsequent that will follow, as well as I think that sort of if you go back to what the Fed was telling us, they felt that the rates even before this were in the restricted territory. And now we've backed up not only rates, smidge on the interest, spreads as well. That gets the overall sort of monetary policy a little bit more restricted than what it was. Now, the Fed, if it had it in its own, could have two rates, one for the lower end of the economy and one for the upper end of the economy. But I think they have to suffice with one. And we do think that they will focus on their second part of their mandate, which is the labor market, a lot more going forward.
Who would you rather be this week, Vishal? Fed Chair Jay Powell or ECB President Christine Lagarde?
Absolutely, Jay Powell. Easier shoes to fill. Economy can withstand this. We are coming into this with very, very strong balance sheets. Now, again, both those central bankers have to focus on the dispersion of opinions and dispersion in the economy that they're going to go through as well. Europe with different countries coming together, one country doing really well versus the other four. And in the U.S., you're seeing a significant K-shaped economy. And this thing, the extra $200 million that the oil price jump will impact, it's going to impact more on that lower end of the K-shaped economy. So tough jobs they have to fulfill, tough shoes to fill in this week.
Vishal, is this a different ECB? Is there anything left of the Trichet ECB in 2008 when they did hike interest rates?
They are looking at history and significantly worried about this thing. They do not want to hike in a period where growth dynamics were deteriorating. Certain parts of their coalition are suffering through deficit issues similar to the US, France, Italy being case in point. They're going to go through some elections. Taxes are very, very high. UK, not in the EU, but still in that similar region, is facing similar issues as well. So they're looking at history and nauseating over this oil shock that we're going through. And that's why we believe that there might be sort of pain points or pain thresholds that we are crossing through as we are extending the duration of this conflict.
History has not been kind to that decision, that's for sure. Vishal, it's good to see you. Thank you, sir. Vishal Khanduja there of Morgan Stanley. The ECB, their decision on Thursday. The two-day meeting of the Federal Reserve begins tomorrow, concludes on Wednesday. Coming up in the next hour, Liz Thomas of SoFi, Jay Goldberg of Seaport, David Seif of Nomura, Barbara Reinhard of Voya Investment Management. The third hour of Bloomberg Surveillance is up next.
Investors are giving this bull market the benefit of the doubt.
This is starting to weigh on the market, but we have not quite seen that typical pullback.
Markets have essentially got an assumption that this could be a quick war.
We don't have a lens on when this is going to end. Nobody does.
The market right now is overly complacent in my mind.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Equities near session highs on the S&P 500, higher by 0.8%. Small caps outperforming, up by 1 percentage point. In the commodity market, Brent and WTI taking shape and looking like this. Brent crude unchanged at 103, WTI at 97, following a weekend full of escalating strikes into this week. This week right here, full of central bank decisions. A Federal Reserve on Wednesday, an ECB, BOE, BOJ a few days away as well.
Yeah, how do you respond to a stagflationary shock? How do you deal with the fact that inflation expectations in the short term are picking up to a significant degree at the same time that potentially this could crimp growth? Not well. That's sort of been history. And right now, the Fed has an easier job, arguably, of the different panoply of central banks that are going to release decisions. The ECB, the Bank of England, I do not envy them, given the fact that they face a bigger hit to growth and potentially a bigger fiscal response that will create some issues for them on the fiscal and the debt side.
We've repriced energy. They need to reprice growth if these moves hold. This from Kuwait moments ago. The team here at Bloomberg just breaking down the cuts to production we've seen across the region in the Middle East right now. Output in Kuwait has fallen to about 1.3 million barrels per day. Before the war in February, that number was 2.6, double what it is right now. For the UAE, that number now has fallen to about 2 million barrels per day. The number before the war for the month of February, 3.56 million. That's just two nations. There's others in the mix as well. But you can see the cuts here. We're talking about half, production cut in half at key producers in the Middle East.
And this is only the third week in. And this is what happens when basically you have the Strait of Hormuz blocked and this product has nowhere to go. We're still waiting on other numbers officially. We know that Iraq's numbers have come down, waiting on the Kingdom of Saudi Arabia. How much have they had to wind down some of their production given what's happening right now? And the issue with the Strait of Hormuz is that there's no answer right now. And everyone says you can pick apart and do little tools here and there. But the only silver bullet you have is reopening that strait. When it comes to the coalition, there's not a lot of countries that are running to the president's help.
The Iranians want you to feel it. They want you to feel the pain to make sure this never happens again. That's the goal of the Iranians. It's basically what we heard from the foreign minister earlier on this morning.
Ceasefire isn't the goal. That's not exactly what they're trying to do. What they're trying to do is to prevent this from ever happening again. And they've talked about $200 per barrel that is being an inevitability and, frankly, almost a goal. What can you do to offset this? What do you do if you are a corporate executive trying to come up with a plan and giving guidance? Good luck.
It's going to be very challenging, whether you're an oil executive or an executive that requires the use, which is pretty much every company, diesel, jet fuel, helium, fertilizer. This is going across not just the crude landscape, but other commodities as well. When it comes to the Strait of Hormuz, then what the Iranians are doing, there have been a tremendous amount of pressure put on this regime, and they are still not saying that they want to come to the table. Not just the Ayatollah and top brass of the regime taken out, but Karg Islands was hit. The military complex on Karg Island was hit. 9 out of every 10 crude barrels that Iran exports goes through that island. So Trump is showing them he can really hit them where it hurts, and it's not working right now.
And here we are Monday morning with equities up by 0.8%. On the S&P 500. Coming up this hour, Liz Thomas of SoFi with stocks on a 3-week decline as conflict in the Middle East sparks volatility. Jay Goldberg of Seaport looking ahead to NVIDIA's AI conference, and David Seif of Nomura counting down to this week's Fed decision. We begin this hour with stocks aiming to snap a 4-day losing streak. Liz Thomas of SoFi writing, periods like this are incredibly uncomfortable and impossible to predict, but it's unlikely that the stock market experiences a prolonged or deep drawdown. Liz joins us now for more. Liz, good to see you in the studio. Good morning.
Good to see you, too. I sound optimistic in that statement.
On the edge of optimism.
Yes.
After a 5% decline, is that it?
In my defense, I wrote that last Wednesday. So
how much has changed in a few trading days?
I mean, here's the thing. This is all about how long this lasts and how many countries are impacted from a growth perspective. Now, this word of stagflation is back, and it's back in a strong way. And I think we're worried about that globally. But I do believe that if this only lasts for, let's say, a month or less, we will be okay. There will be a snapback. And generally, I would say it's likely that we go back to the trends that were in place in January and maybe early February, that sort of cyclical rotation in the market. It's obvious to me that investors still have risk appetite. They're looking to position themselves in places that have been beaten down. So we've had some rough days throughout this conflict, but it was interesting, even in the early days, you saw something like software bounce on those rough days. So there's risk appetite there, I think. As long as we don't destroy that risk appetite, we still have an opportunity to bounce back if this de-escalates.
You can see how this has played out in commodities and energy, obviously, and you can see that's how this has played out in rates, in yields, and how we're pricing central banks and easing or not over the next year or so. Where have you seen it play out in equities? Have you seen any pockets of capitulation in the equity market?
Well, I think the ones that had been beaten down already, I already mentioned software. I think that found its bottom, or at least is in the bottoming process, and investors are looking for ways to position in some of those that maybe were called falling knives before, but now the knife has fallen, right? So looking for opportunities. And something like software, even before this conflict began, it was trading as if the entire industry was going to disappear. And that's probably not going to happen. Will there be disruption? Of course. But disappearance? Probably not. So I think I'm willing to leg into it and watch how this plays out as the year progresses. Other places that have been hit pretty hard by this, I mean, all of the cyclical sectors have been hit hard. Industrials, materials, even consumer discretionary and staples have been hit because we have this big question mark of how much will companies pass through if there is an inflationary shock and the consumer has to pull back. Rather than saying a certain spot in the market, I'd like to see consumer confidence bounce back. And if inflation feels like it's more under control or we're not going to have this prolonged shock, I think consumer confidence will bounce back pretty quickly.
I think that John's question really points to the paddling duck aspect of this market, the idea that each sector has been really operating on its own dynamics. And you've seen, half the stocks go up 20%, half the stocks go down 20%. And sure, the index looks flat, but a lot's going on under the surface. How long can that feature be a feature of resilience versus really challenged should there be a true growth scare in the United States?
So what I think you need to see, and this is, I'm going to answer both of your questions at the same time here. True capitulation is something that happens when you see correlation and volatility rise together. And I don't think we've really seen that yet, at least not even for a full trading day. We saw it the Tuesday after this conflict began. We saw it in the morning. It was a really rough Tuesday morning. Everything was down. The good stuff was being thrown out with the bad stuff. If that happens for a few days, then I think you've reached that peak fear. I don't think we've priced in peak fear yet. And unfortunately, we might need to see a full flush before we can find some more footing. But as I mentioned to John, the risk appetite for cyclicals and some of the spots that are looking more attractively valued, I think is still healthy. So it's still alive. So that sort of paddling duck under the surface is still looking for places to buy in equities. And that, I think, as long as it remains alive, is a good thing for strength ahead. That's all sort of caveated by, let's say this does last over a month, and let's say break-even inflation rates spike and stay elevated. Let's say we've got a Fed who talks this Wednesday about stagflationary risks or starts to give us the impression that they're more concerned about inflation than jobs. Then I think we've got a conversation where something like hikes comes back onto the table later this year, which would probably terrify markets.
Would that make you more bullish or less bullish on the long end of the yield curve?
On the long end of the yield curve, less bullish. And I think we've seen the 10-year rise over this period for good reason. I mean, this would end up being an inflationary shock in many ways. And there is some maybe saving grace that we are a net exporter of oil. So as prices rise, there are certain spots in the U.S. economy that could benefit from that. But the consumer drives our economy. And if you've got a consumer that's under pressure already from inflation and has been for a number of years, and now we're taking one of the non-negotiable items of their spending, which is energy and particularly gasoline, to get to work, take your kids to school, and pressuring that, then we've got a consumer that has to pull back and make different decisions in other places.
The round trip on bond yields has been unreal. February up 30, or rather down 30 basis points, and then March up 30 basis points, back to where we were at the start of last month.
Yeah, and a full range of one particular benchmark yield. I mean, it's not exactly moving that much out of that range. I do wonder, though, is this going to be recessionary or disinflationary down the line? I guess that's the real question, because if you start to spend less, does that cause the economy to grow more slowly or even contract and lead to lower yields down the line? This is sort of one of the big debates right now on Wall Street.
Let's mention consumer confidence. Mitch, came out on Friday going into the weekend. Sentiment 3-month low. The survey director said this to us: the sentiment readings that came in after the attacks were considerably lower than what we were collecting beforehand. The survey period, really important here. It was between Feb 17th and March 9th. So ultimately, anything that came afterwards, you saw a very different picture. I wonder, Liz, in your mind, and just to wrap things up, do you think this is going to change how consumers interact with the economy when they get those tax refunds, which were meant to fuel a cyclical bounce in this economy?
Yes, I think in the near term it will. And there are two different consumer confidence readings. There's the University of Michigan and there's the Conference Board. The questions for University of Michigan skew towards inflation more than jobs, Conference Board more toward jobs. So I would expect that we see a bigger hit to the University of Michigan numbers than the Conference Board numbers. But yes, in the near term, consumers do usually pull back. I think we're still in an era, though, where the consumer will just hit pause and not stop and not reverse yet. We haven't gotten to a point in gas prices yet, I think, where people have seen demand destruction or entirely changed their behavior. But there is a pause button that gets hit, and you'll see that sort of bake through into the data. One of the things that's really important to watch in this upcoming earnings season is operating margins, to see if companies have needed to start managing their cost structure differently. I don't expect... Operating margins are very strong right now, in fact, above trend. So there is some buffer to absorb this. But I don't expect that there's companies that are going to manage it yet. But you do want to watch that line, that operating margin line, for a rollover, even just the beginning of a rollover, and then sort of manage your expectations if it starts to come down.
Liz, this was awesome. It's good to see you in person. Thanks for being here.
Thank you.
Liz Thomas there of SoFi, breaking down this market. You mentioned earnings season and corporate executives who will need to talk about this. That's about a month away, the middle of April, when the bank earnings begin.
Yeah, they're probably glad they've got a little time to see how long this is going to go on. And to the point of that one big, beautiful bill, I still go back to this. Deutsche Bank economists think that a sustained oil price around $100 a barrel would be manageable and actually would be offset entirely and then some by the one big, beautiful bill. But $150, another story, even $130. So there's definitely is a sort of sea change as it goes higher.
But not if some of that money was already spent, because consumers knew it was coming down the pipeline. They maybe spent it during the holiday season or in January when electricity prices were higher. This is going to get incredibly challenging for this administration as gas prices continue to tick higher. In some states, it's already above $5 a gallon. And I think when it gets to 4 and continues tracking to 5, that's when you can see more of these controversial tools coming out of the toolbox.
Average around 370 at the moment and climbing pretty quickly. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Treasury Secretary Scott Bessent saying this morning he sees more and more oil going through the Strait of Hormuz and expects oil prices to fall, quote, much lower than $80 a barrel in the coming months. Bessent went on to say his recent talks with his Chinese counterparts in Paris went well, and it's false to say President Trump's scheduled trip to China may be delayed due to the war. Iranian authorities are not seeking a ceasefire as the war enters its third week. The country's foreign minister saying, quote, this war must end in such a way that our enemies never again think of repeating these attacks. President Trump saying Washington is talking to Tehran, but he's not sure if Iranians were ready. And U.S. allies responding to President Trump's calls to form a coalition to support safe passage through the Strait of Hormuz. UK Prime Minister Keir Starmer saying efforts to reopen the strait won't come as a NATO mission, but the UK will work with partners on a plan. A spokesperson for the German government also saying Germany won't provide military support in Iran, calling the war unrelated to NATO. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus, Jay Goldberg of Seaport Global looking ahead to NVIDIA's AI conference. Live from New York City this morning. Good morning.
Most assets should be able to come back within a month to 2 months if and when the war ends. Another key assumption in our numbers is that Hormuz is going to be reopening, which might also be maybe too far-fetched an assumption. We are always one step away from a major escalation on the energy side, and that's, I think, the fear your market has.
I would say that was a balanced interview with Francisco Blanch of Bank of America a little bit earlier, aware of the risk but constructive on the outlook and confident that we can bounce back from this shock if it ends quickly, and that's a big if. Right now, crude looks like this. Brent pulling back by just 0.1%. Brent 103, WTI 96.60 and down 2 percentage points. That move sets the tone for this. Just helps equities on the margin following a 4-day slide. A 4-day losing streak coming into Monday on the S&P. We bounced back by 0.9% on the S&P. On the Nasdaq, up by 1 full percentage point. That's the price action. Let's get you some morning calls. First up, Wells Fargo cutting its price target on United Airlines to 130, citing risks from higher fuel prices. Your second call from Seaport Research downgrading Qualcomm to sell, saying the memory crunch is going to hit its customers the hardest. And finally, from RBC, raising its price target on Micron to 525, expecting data center demand to drive multiple expansion. That stock is up in the pre-market by 4%. Let's stick with tech. Nvidia's annual AI conference kicking off today. Traders looking for a fresh catalyst, with the stock trading lower despite last month's blowout earnings report. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, buddy. What are you looking for later?
Yeah, I mean, a fresh catalyst is exactly what the street is looking for, John. But that catalyst is going to have to be pretty spectacular to move the needle. You know, like the problem with Nvidia is that it's a stock that's traded in a very narrow range, sideways essentially, for more than 6 months. And all of the growth that came from some 2022 through 2024 that was predicated on real revenues growth, nothing's really changed since. So Nvidia has this guidance for $500 billion of data center sales through the end of the year. And they'd already kind of indicated at the start of this year that they were tracking beyond that. If you basically, both across the buy side and sell side, were to summarize the sentiment, that $500 billion figure is going to have to change enormously to move the needle here. But it is, how can I say this with respect? It can be a bit of a circus. It's 48 hours of just Nvidia everything, where you hear from the main man, Jensen Huang himself, half a dozen times. So brace.
Stock has done nothing for more than 4 months. It needs to start doing something, that's for sure. It's negative on the year so far. Ed, before you go, I wanted to squeeze in this from Reuters. Meta. This could be a big story. Planning sweeping layoffs, according to Reuters, that could affect 20% or more of the company. Is this a block-type play? What do you think this is?
Yeah, the interpretation is that it is a block-type play, that there's limited sell-side reaction, but they're all looking at it and saying, actually, following on from block, decreasing headcount such that it is, Meta is a good candidate to follow suit, and it would... The reason the stock might be higher in pre-market is that it would be evidence that AI is having a positive, meaningful impact for Meta to make that change. I would also note, capital expenditures or R&D, that their spending tracks very high relative to peers. And so maybe, that either justifies it or they'll have to pull back on some things. But that certainly is the signal from the market in how this is being read.
Stock is up by 3% in the pre-market. Ed, good to see you. Looking forward to the show later. Bloomberg Technology, a few hours away. Meta employs about 80,000 people. 20% is not nothing, that's for sure.
And we've seen them already engage with rounds of layoffs like this, right? The year of efficiency led to the year of investment. This time, they're still investing a tremendous amount of money, but it is not going to increasing their staff. And that really speaks to the trend right now in tech.
Let's keep it on tech and talk about Nvidia. Jay Goldberg of Seaport Global has a rare sell rating and 140 price target on shares of Nvidia, writing this will likely be a tough year, buffeted by shortages and rising costs without the demand to bolster their results. Jay joins us now for more. Jay, welcome to the show. Let's talk about the difference between vision and execution. Today might be about vision. Why is the execution a problem?
I think the execution is a problem in part for a lot of factors beyond NVIDIA's control, right? One of their big limitations right now, why they can't take numbers up higher, is because they're limited at the capacity they got allocated by TSMC, right? TSMC can only make and can only package so many NVIDIA chips. NVIDIA's getting everything they can out of TSMC this year, and that's a pretty hard constraint. I think you look a little bit further out, there's also, I think, growing friction in trying to finance these data centers, right? I saw statistics yesterday that you look at the hyperscalers, they have something like $700 billion in operating leases off their books. And these, in order for NVIDIA's numbers to keep moving up in a way that I think will make people happy, you need to have some really big numbers. People have to pay for it. And that's getting harder and harder with the size of some of these data centers that are coming online in the next year or two.
Jay, do you expect to get any guidance as to what the Iran war is potentially going to mean for NVIDIA? And I say this, Annmarie made a great point about 33% of the world's helium transports through the strait, and that is crucial for TSMC's production of chips and the world's majority of them. I mean, do you have a sense of how some of the big tech players, NVIDIA primarily among them, are really viewing this?
I think the primary concern around the Iran war for semis this year is more on the demand side. What that's going to do demand, you just had a guest on talking about oil prices going way up. That's going to crimp consumer demand and just make people a little more risk averse when it comes to investing hundreds of billions of dollars in data centers. In terms of little spot shortages like helium, I think there's a pretty good amount of helium already in reserves out there. I'm not so worried specifically about that one component. But you have to remember, in the context of everything in semiconductors is constrained right now, helium is just one more constraint. There's a lot of bottlenecks in the industry right now.
But Jay, on this point, when it comes to a company like NVIDIA, you had Jensen Huang with the president a year ago on that Middle East trip. I spoke to him in Riyadh. He was so excited about data centers in Saudi Arabia and the UAE. Do they need to rethink that rollout?
I think geopolitics are a giant wild card for the whole industry that nobody can predict right now. I mean, on that right after that same trip, the president tweeted out that they'd reached an agreement for NVIDIA to sell chips to China. We still don't have that, right? So we're still sort of bottlenecked by that as well. Certainly, data center construction, I'm imagining, is not a high priority in the Gulf right now, and that's going to be a concern for lots of players here. But I think that's sort of for me, like worrying about the Iran war, there are bigger concerns than data centers and AI getting built.
Well, what are the bigger concerns? You mentioned China. We do have the president potentially weighing not going to Beijing on this trip. You mentioned these chips that are not even going to China yet. Does China have the appetite for the level of chips that the United States is willing to send?
I think there is a lot of demand out there for AI chips. And I think what's happening is this big meteor of demand has hit the industry and is rippling across. And NVIDIA got sold out first. Now we see that demand spreading to other companies like Broadcom, who I think is still very well positioned here. AMD starts to get into the mix as well, right? If you look at the numbers, NVIDIA is at sort of 83% share of data center semiconductors right now. And that's sort of plateaued, right? Where do you go from 83% share? It's hard to go up much from that. And I think if NVIDIA's going to it's gotten what share it has, and now we see competitors have seen the door cracked open for them, and they're rushing in there.
Hey, Jay, it's good to see you. Thank you, buddy. Jay Goldberg there of Seaport Global. Ahead of this developers conference a little bit later, Ed Ludlow, Caroline Hyde will guide you through that story later on today. Big tailwind for that company coming into this year was the sovereign story. And a lot of that was coming out of the Middle East. And I wonder to what extent that's been upended by the past few weeks.
Absolutely. A lot of money was being sent by these hyperscalers to the UAE, to Saudi Arabia, to create these data centers. What are they going to do in the future? These data centers now need to go underground because they're concerned of the security risk. This is a huge problem. Also, if you are shipping these chips from Taiwan to the United States, how are you doing that? It's going to be a lot more expensive, and potentially you have to avoid a huge region in the global world.
And these countries are making less money. We've seen the production numbers this morning coming out of UAE and Kuwait. Production cut in half, basically, as some of those key producers across the Middle East. Up next on the programme, David Seif of Nomura counting down to this week's Fed decision. Plus, Danny Berger has your morning movers. Micron rising ahead of results this week. Their stock is up by 4%. Stocks are higher by 0.9% on the S&P 500 following a four-day losing streak through Friday, and coming into Monday, we bounced by 1% on the Nasdaq and by 1% plus on the Russell 2000. In the commodity market, the highs overnight, 106.50 on Brent. The high overnight on WTI, 102.44. We're off those levels, 103 on Brent. WTI at 96.60, and that's breathing some life into this equity market rally. In the bond market, major moves on the month so far. Yields higher by some 30 basis points across the curve, 2s and 10s. Coming into Monday, we declined by 4 basis points across the curve, 2s out to 10s. The 10-year at 4.24, the 2-year at 3.67. The Fed meets on Wednesday, and some major questions about how they take this move in crude and put it into their outlook?
The way that the market has put it into their outlook is by subtracting one rate cut from their expectations. When you look at Fed funds futures, there now is one full rate cut being priced in, and only at the end of the year. Do you get confirmation of that? Do you start to hear about geopolitics? Do you start to hear about the idea that even transitory shocks could have big ramifications in the short term for inflation expectations? The rhetoric will be key.
It's a four-part act coming up on Wednesday. You've got the statement, the news conference, the outlook, and then the political cloud just hanging over the Federal Reserve at the same time. Some big questions about the future of Chairman Powell. You know, when I was asked this question a few times about whether he'd step down in May and just, enjoy retirement, make some real money again, away from the central bank, which compared to his PE money days is like nothing.
It's not real money.
He needs to make real money. I'm sure there's a lifestyle to upkeep. But for him, I do wonder if he stays around now, because these legal issues are just not going away.
They're not going away, even though the White House, in a sense, was gifted a gift over the weekend. On Friday, you had the U.S. District Court basically saying you cannot subpoena the Federal Reserve. And then you had Attorney Pirro come out and say, what we are going to do is continue the investigation and we will appeal this. Okay, then it went silent until just after midnight tonight, the president unleashed on Jay Powell and the district court for what they're doing. So it doesn't seem like they're trying to wrap this up anytime soon.
The senator from North Carolina is a key player here, Tom Tillis, good friend of this program over the years. He's basically saying just take the out. Why are you not taking the out? The off-ramp is there. Your guy's lined up. We're going to confirm him in the Senate and we can move on. Here's the off-ramp. Take it, but they're not taking the off-ramp.
I can't answer that question, but it feels a little bit like when you're in third grade and you say, you're a dummy. No, you are. No, you are. And you keep saying it because no one's willing to stop. It feels a little bit like that.
The funniest part of that press conference was every reporter kept asking about Senator Tillis, and clearly Attorney Pirro was getting very annoyed because she said her lane is not politics. And at one point she goes, I don't even know who he is, talking about Kevin Warsh. I'm not sure the incoming potential Fed chair liked the idea of that.
There you go. We'll get back to that story in just a moment. Equity futures positive here by 0.9%. The opening bound just around the corner, less than 1 hour away. Let's get you some morning movers, some single names. Danny has more. Hey, Danny.
Hey, John, a little bit of deal news this morning. Public Storage will be buying National Storage, creating a $57 billion storage giant. The deal size is about $5.6 billion. They're offering just over $42 a share for National Storage. So you can say we're surging. We're not even at the deal price yet. That moves higher by 27% in the pre-market. Public Storage sinks by about 4% in the pre-market trade. Elsewhere, we do have some earnings, some big earnings coming up this week. We're going to hear from Micron on Wednesday. The sell side very bullish, out with a lot of upgrades. And again, bullish language ahead of that. So we are seeing the shares rally 3.9% in the pre-market. TD Cowen says that they expect a big beat in RBC, lifting their guidance ahead of those results. Again, they come on Wednesday. Finally, rounding things out with another set of earnings from Dollar Tree this morning. Shares up 1.9% in the past year. They swung to a profit after a loss in the quarter prior. However, their outlook was somewhat muted. It slightly missed expectations, but just want to point out Dollar General had some pretty poor earnings last week. They also had expectations that didn't meet the bar of Wall Street for these value-seeking stores. So some of that might already be priced in. Shares moving nearly 2%, John.
Danny, appreciate the update. Danny, thank you. Danny Berg and Matt Miller coming up on Bloomberg TV in about 30 minutes' time to guide you into the opening bow. Look out for that a little bit later. Traders awaiting this week's Fed rate decision. It's just around the corner. The central bank widely expected to keep interest rates on hold. Bloomberg's Enda Curran joins us now for more. Enda, we talk about that 3-4-part act. Let's park the politics and focus on the three. A statement, a news conference, the projections. What are you and the team focused on down in Washington?
So the real action is going to be, this will be the first time we get to hear from the Fed, John, in terms of their response to the Iran war and the oil shock. As you mentioned, no change to policy expected, but they're going to put out new forecasts that are expected to show an increase in their outlook for inflation. That will be interesting. And at the same time, they're going to nudge down, or expected to nudge down, their outlook for growth. So then when you consider the fact that we're at that point where hawks are really in control of the FOMC committee at the moment, those ones who are more worried about inflation than anything else. When you consider that weak February employment number and the fact that there are those warning $100 a barrel oil will eventually, once you look through it, become a tax on consumers and business and will impact growth, then I think what we could see on Wednesday is the start or the beginning of the Fed debate around how will they respond to that Iran oil shock, and will it ultimately result in rate cuts, and will they, of course, start to use the word transitory again?
And do we have an appreciation for where inflation is right now? And the reason I raise that question is because many people in the economics industry were looking at the PCE data on Friday into the weekend and were focused on the methodology that was used for certain indicators, certain readings on things like legal fees. What's your takeaway of what's going on at the moment?
I think, look, inflation remains above the Fed's target. It's certainly a core PCE, their own preferred gauge, is still beyond, their comfort zone. But, John, it's broadly, what I'll say, stable, perhaps. By component, there's certainly different signals being given off. For example, the goods sector, we saw in those numbers last week, the inflation story there is still somewhat mixed. But the service side of things, you look at the insurance sector, you look at periodically cost linked to education, tuition, healthcare and the like. There's clearly parts of the economy where inflation is real, sticky and persistent. And that's why the hawks on the FMC are in control at the moment. And that's why we had several at the last Fed meeting warning that at some point they may need to start talking about hikes. Now, I think this Iran shock might put a different hue on the debate at the Fed. I'm not necessarily sure if the Fed will be talking about hikes near term. It's probably going to be more of a story of looking through that. But there's no doubt about it in terms of the Fed getting back to its inflation target. I mean, that remains a long way off for now.
And good to see you. And Karen down in Washington. Appreciate your time, sir. David Seif there of Nomura weighing in on the Fed's path forward, writing this. We continue to expect 2 cuts in June and September under Chair nominee Warsh. We do not think that the Iran conflict significantly lowers the likelihood of Fed rate cuts. A man who knows who Kevin Warsh is. David joins us now for more. David, good morning.
Good morning.
I'm sure you'll let that joke slide. It's good to see you. Let's talk about what you're expecting from this chairman. Chairman Powell in his penultimate meeting, I believe, on Wednesday.
Yeah, well, we're certainly not expecting any change from the Fed, and I think that at this meeting, and I think Chair Powell has to continue to reflect the entire committee as he does at every press conference, and so really separate from what's going on in Iran, there has been, I would say, a change in Fed rhetoric. Not from the core of the committee like Powell, but from some members of the committee who have gotten a little bit more hawkish. So we might see Powell reflect that. At the same time, we had an 11-1 decision with only one dovish dissent at the January meeting. We could easily see this as a 9-3, which is our base case, with 3 dovish dissents. So Myron this time joined by Bowman and Waller, all 3 of them dissenting. So the decision itself could actually be seen as dovish, with 3 people voting for a cut instead of just 1, with the press conference a little bit more hawkish. When it comes to Iran, though, we really just don't see this having a big impact on Fed policy at this point. So sure, the statement will, of course, acknowledge geopolitical risk. It might not use the word Iran, but we really just don't think this is actually that major for the Fed, despite changes in market pricing.
At this point, how much is that phrase doing some heavy lifting?
It's not doing as much heavy lifting as you might think. I think that the Fed will have to increasingly acknowledge the two-sided risks from this. But the important thing is that it's two-sided risks. So yes, this has raised oil prices. It will probably raise headline inflation. But the Fed really focuses in on core inflation, and that's really important here. And so we really just don't see a huge amount of pass-through from this sort of headline inflation rise, which is really oil-focused, into core inflation. And so we look to the Fed to probably look through this. I think it would take a lot longer of a conflict, significantly more than the, say, additional month that markets are thinking, before the Fed really has to consider this. And it's not even clear that its response would be to be more hawkish, as is being priced in.
That said, even stripping this conflict out, looking at core inflation, it's actually inflecting upward so far this year. And you're seeing a lot of services and goods that have actually been getting expensive at a faster pace. How can they really reject that?
Well, there's no question that we've been seeing some elements of supercore inflation start to creep up a little bit. And that has, again, nothing to do with the Iran war. I think that is why you've been seeing, as I was talking about before, some members of the FOMC become a little bit more hawkish. And Powell may have to reflect this. It's not really clear that he himself feels that way. But again, we're at the cusp of a major change in Fed leadership, one that we think is going to bring more dovishness to it. And so even if a Powell-led Fed were Powell to remain as chair for, say, another couple of years, even if that was something that was likely to get more hawkish outside of the effect of the Iran war, it's really not clear that Chair Warsh, once he's confirmed, is going to be on board with that at all.
Can we go down a little rabbit hole with core PCE? There was a huge debate over the weekend about a key aspect of core PCE that was changed without disclosing it. Legal services.
Yeah.
If they hadn't changed the methodology, that would have been up more than 11%. Instead, it was up less than 1%,
yes.
which seriously skewed the entire data, which normally is completely predictable based on the other inputs.
Yes.
Is this a political act by the BEA? Is this how do you take this and understand it in the framework of whether some of these numbers are legitimate?
Yeah, I'll tell you, it does seem like the BEA sort of changed horses in midstream here, and usually we, along with many other forecasters, are extremely accurate. Almost everybody was off by a full 10 basis points, which is a big miss on this. And it was essentially 100% due to this legal services fee change. And it was just a matter of, usually it's taken from the CPI when it goes into PCE, and this time it was taken from the PPI. There was no advance warning given on that, and that made a big difference here. I think some criticism is pretty justified. I can't say whether it was political or not. I will say in the BEA's defense that the BEA does have more discretion than the BLS, which comes up with the CPI and PPI numbers, to do these sort of methodological changes. And had it made this change where it didn't matter so much, I think there would have been a little bit of people shrugging their shoulders. I think what is leading to this debate and criticism, which I think is at least somewhat fair, is that they made this change right when it mattered the most. And you know, it is what it is. I don't think there's any way to sort of sugarcoat that is what happened.
Timing isn't great. Let's finish on the calendar. The chairman of the Federal Reserve, Chair Powell, March 18th, April 29th, then he should be done.
Yes.
What are the prospects of him hanging around?
I think there's really three options here. One is, does he leave immediately? Two, does he wait out the midterms and see whether he can if the Democrats win the Senate, he might be able to resign after a few months and prevent Trump from at least nominating a successor and leave the seat vacant indefinitely, or force a compromise candidate, or stay around forever. I don't think he's going to stay around for the rest of his term, which would be until 2028. But I do think that as Democratic prospects of taking the Senate rise, it does make it increasingly attractive for him to at least take a look at and see how November goes.
That screams politics, doesn't it?
It does scream politics.
Is he a political beast?
I think that Powell avoided politics for quite some time, as much as he possibly could. And it was really a sea change what happened on January 11th with his response to the subpoenas, which do not appear to be going away anytime soon. It does appear that he has based some of his statements. But let me piece those things
together, because those pieces of information, your view is important. You just said you don't think the subpoenas are going away. One, there's a prospect that Powell stays until November. Two, doesn't that raise a question about the future of Warsh's nomination?
Subpoenas did not go away despite the ruling from the district court. I do not think that they will be a constraint to Warsh being, in practice, to Warsh being confirmed. I think they will be withdrawn if necessary in order to make sure that Warsh is confirmed in time for him to be on there for the June meeting.
So basically you think Pirro at some point stops the investigation, because Senator Tillis has been very emphatic that he will not go ahead unless the investigation to the Fed is dropped.
I think Tillis is likely credible. There are ways around that in the Senate. I don't think that Thune would necessarily use them. So yes, I mean, I think that they will keep this investigation going as long as they can, but will ultimately withdraw it or end it in time to make sure that Warsh is confirmed for the June meeting.
OK. David, good to see you.
Great
Thanks for dropping by. David Seif of Nomura on what could be a messy summer for the Federal Reserve. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Iran launching fresh attacks across the Persian Gulf as the war enters its third week. The UAE and Saudi Arabia reporting drone and missile attacks overnight, with the key Fujairah export terminal suffering another hit. The repeated strikes have led to the UAE cutting its oil production by nearly half since the war began. Elsewhere, Meta is planning layoffs that could affect at least 20% of the company. Reuters reporting that top executives have signaled the plans to other senior leaders at Meta. No dates for the cuts has been set, and the scale of the layoffs has not been finalized. The cuts are aimed at offsetting costly investments in AI infrastructure. And a top Apollo executive is sounding off on, quote, the arrogance in private markets. The Wall Street Journal reporting the firm's co-president of its asset management arm blaming the media for creating a frenzy around private credit. John Zito saying, quote, obviously we're in the middle of a private credit party, apparently. If you do credit well, it's supposed to be pretty boring. That's your Bloomberg Brief. John?
Yahara, appreciate the update. Thanks for this morning. Thank you. Up next on the programme, setting you up for the day ahead. Plus, we'll touch base with Barbara Reinhard of Voya Investment Management as the conflict in the Middle East whipsaws equities. Equities this morning up by 1% from New York. You're watching Bloomberg TV.
It's crazy to me that you see all these narratives being written that central banks are going to tighten into this. I think central banks have learned along the way you don't tighten into energy shocks. I think if anything, if this gets worse than people anticipate, we should be talking about more cuts, not less cuts down the line.
You hope they've learned along the way. Is I imagine what Chris Verrone of Strategas was meant to say a little bit earlier when he spoke to us earlier on this morning. Equities are doing better this morning. On the S&P 500, firmer by 1%. On the Nasdaq, up by 1.1. On the Russell, up by 1.3. Two pillars of support this morning. One is a shaky one. We'll talk about it now. Brent and WTI. Brent crude off the highs from overnight. 102 at the moment and down 1%. WTI breaking 95 now. We're down by about 3.9%. That is a fragile pillar of support because that can change any second, any moment. The tone out of the talks over the weekend with China and the US, constructive, even if, as the press secretary suggested just moments ago, Caroline Leavitt, that meeting between Trump and Xi might be delayed. China and the US agreed to stable trade ties to benefit the world. The readout of that meeting coming from the Chinese side just moments ago.
So basically the Chinese side is saying this détente, we want it to last and we want a working relationship with the United States. What's interesting about this meeting, though, is I actually long thought the second Trump had these strikes on Iran, the meeting would be delayed because the Chinese like everything to be done ahead of time. And this is the first real meeting we've seen before that meeting is set to take place in just 2 weeks' time. So a lot of the deliverables aren't yet on the table, and Trump is now solely focused on trying to reopen the Strait of Hormuz.
And that is a major focus, not just for him, but for everybody else as well. As we count you down to the opening bell, this is the trading diary for the week ahead. At 2 p.m. Eastern Time, the NVIDIA CEO, Jensen Huang, speaking at the company's AI conference. Look out for that. Look out for this too. 3:30 Eastern Time, the President and Vice President J.D. Vance speaking to the press. The Vice President's been fairly quiet recently. His thoughts, hopefully, on the war coming up a little bit later. On Wednesday, PPI data plus a Fed rate decision with Chairman Powell. On Thursday, rate decisions from the BOJ, ECB and BOE, plus another read on the labour market. Jobless claims just around the corner. Barbara Reinhard of Voya Investment Management writes this about the market. There is a real risk of a whipsaw in equities because of the news-related nature of the war. And this is clearly a highly uncertain time for investors to make any major bets. Barbara joins us now for more. Barbara, good morning. Good to see you.
Good morning.
Our capacity to absorb shocks with the stock market just 5% away from all-time highs. Is there a cushion there?
The valuation cushion certainly isn't there, but the fundamentals going into this war were actually quite good, right? You had wage inflation was coming down pretty dramatically. You were close to the Fed's target on core personal consumption expenditures or getting there. So the fundamentals were great, and you also had very good earnings support. So going into this, it's very different than it was in 2022 when you had inflation was rampant. PCE at the time was over 5.5%. Wage inflation was spiraling, and you had a Fed that had to be very aggressive. Turning into this one, you had an easing of monetary policy, you had fiscal support, and you had very strong earnings. So it's a very different place than we were in 2022.
It seems like no one's really worried about a massive drawdown. They're all worried about missing out on the upswing when you do get some sort of resolution to this. Would you say that's accurate?
Well, there's been a lot of nervousness underneath the market. While maybe the S&P is only about 4.5% off of its all-time high, the internals of the market have been very weak, right? Liquidity has been very low. There's been a lot of reduction in length and positions. And also, if you think about where most of the assets had gone in the first 2 months of this year into the emerging markets and into Europe, those markets are down closer to 10%. So we see that there's been some relative weakness. Some of our short-term sentiment indicators are oversold, but they're not looking at capitulation yet, where you would say shut your eyes and buy. The thing to do at this point, from our view at Voya, is that when you have an initial surge in oil prices, bond yields generally get dragged up with it. We do not think that any central bank is going to be hiking into this. This is a supply shock, not necessarily a demand shock. So if you want to do something in your portfolios, probably buying some duration at this point would be a very good bet.
That's what we've been hearing from a number of guests so far this morning. Is that because there is an expectation that growth will have to slow, or is it just simply capitalizing on the wrong way bets that people are making, which seems to make sense in the short run but never does in the long run?
Well, I think there's two things. Number one, no central bank is going to be hiking into this, right? This is a supply shock that consumers are going to be feeling in their purses, and bond yields get brought down because consumption starts to slow. More of your pocketbook has to get spent on energy and gasoline prices. That, of course, is going to slow inflation pretty dramatically, and that's why bond yields are likely to fall off of this.
What kind of levels in WTI, Brent, or gasoline do you predict potentially mean that this would actually impact growth and impact consumers?
In order for it to really hurt the U.S. in a significant way, you would probably need to see Brent somewhere around, WTI, somewhere around $140 a barrel for a pretty long period of time, like 2 to 3 months, in order for it to really hit the U.S. economy very hard.
If the bond market's a buy, are energy stocks a sell?
Oh, so look, if the bond market's a buy, unfortunately, it's the news-related nature of this. If you're selling equities today, there's a real chance you could get whipsawed on something
in both directions.
Yeah, exactly. That the straits suddenly open up or they suddenly end up shutting down again. So I think if you're going to look at this for a longer-term time period, like we do when we're investing for retirement, you try to invest through these political shocks. And if you can get a capitulation, oversold environment, that's when you would potentially start to add.
Have we seen that capitulation yet, do you think?
I don't think you've seen it necessarily in the U.S. If you were to get another 10% drawdown from here, or even maybe another 5 to 5.5, you might start to see it. We look at things like AAII bull bear. We look at the put call ratio. We also have weekly sentiment indicators and also our own homemade ones. You haven't seen capitulation. You've seen distress. You've seen low liquidity levels. But you haven't seen it where you would say, shut your eyes and buy.
Not seeing it this morning either. Barbara, good to see you.
Nice to
Thanks
meet
for being here. Thank you. Barbara Reinhard there, Voya Investment Management. Equities this morning higher by 0.9% on the S&P 500. A lot can change between now and tomorrow morning. In the meantime, crude is lower by 3.5%, 95 on WTI, Brent at 102. Coming up tomorrow, Julian Emmanuel of Evercore, Bob McNally of Rapid Energy, Liz Ann Saunders of Charles Schwab, and Lisa Hornby of Schroders. Monday morning, and some of you wishing for Friday already. From New York City this morning, good morning. This was Bloomberg Surveillance.